Hello everyone, welcome back. Hi, my name is Professor Bhavin Gandhi and I am a chartered accountant and company secretary by qualifications. And guys, let me welcome you all to this revision series conducted by JK Shah classes for your Inter CA course. So guys, today we are going to start with revision of Financial Management, chapter number 4, Cost of Capital. So guys, before we start with the revision of this particular chapter, let me just quickly revise paper pattern for you. As you all are aware that your financial management is your paper 8 of group 2 constituting 60 marks, and we share this particular subject with economics of 40 marks. And guys, your 60 marks paper will have question number 1, which will be your compulsory question for 20 marks, and from your question number 2 to question number 6, out of those 5 questions we have to attempt any 4 questions of 10 marks each. So guys, that will be 10 marks into 4 questions, 40 marks, and your question number 1, which will be your compulsory question for 20 marks. So together it will be for 60 marks. And question number 1, my dear students, will have no internal options available. So there can be 4 questions of 5 marks each. So that will be for 20 marks. And between your question number 2 to question number 6, you can attempt any 4 questions out of 5. Usually one of the question is your theory question, so you can keep that particular theory question as an optional question as well, but I would not recommend that. I would recommend you to study your theory adequately from your JKSC textbook, and so that if suppose sometimes there is a particular question which is out of the box or which is quite lengthy to solve, then theory can come to your rescue as well. So guys, theory questions can be anywhere between 4 marks to 6 marks, and that can constitute one whole question of 10 marks as well. And cost of capital, my dear students, is one of the most important chapters in your examination, and almost in every attempt you will see a question on cost of capital for approximately anywhere between 5 marks to sometimes 15 marks as well. So guys, let us quickly revise this particular chapter. Also at the same time, I would like to tell you that in this revision series and in this revision of financial management, first I will not be solving any of the question here, but we will be thoroughly revising all the concepts of this particular chapter. So if you have your JKSC material with you, please keep it open, and we'll be revising each and every question and whatever are the important concepts regarding the particular question, which all things you have to emphasize on, which all things are important from the examination perspective. We'll be focusing on all of that. So guys, let's get started with your revision. So first of all, this cost of capital chapter, we will classify that this particular chapter will have 3 types of questions. The first type will be calculation of your specific cost of capital. So guys, specific cost of capital only means calculation of either KD or KE or KP or KR. And the second type of questions in this chapter will be calculation of your weighted average cost of capital, which we call it as WACC. And guys, the third type of the questions which can come in this chapter is regarding your capital structure theories. So guys, capital structure theories in your study module, you will see this with your capital structure chapter, but we have covered this particular capital structure theories in your cost of capital itself, because first you all should know how to calculate cost, then KD, KP, then how do you calculate your overall cost of capital, and only after that you will be able to calculate your capital structure theory. So at the time of revision also, you have to be very careful that when to revise those capital structure theories, so after your cost of capital chapter gets completed. Okay. So guys, as I told you, there are 3 types of questions in this particular chapter. The first type of the question is simply regarding calculation of specific cost of capital, and let us start the revision with the same. So guys, while you are calculating your cost of debt, which we denoted by sign KD, so how do you calculate your KD? So KD will be nothing but interest into 1 minus tax upon net proceeds into 100, and if the KD is redeemable, then we will be taking KD is equal to interest into 1 minus tax plus whatever is your RV minus NP upon N, the whole upon RV plus NP upon 2 into 100. Okay. So guys, when we are revising it, just make sure that all the formulas also you revise this along with me. Okay. So we are not going to write down the formulas or something, but for your understanding, for your quick revision, you should know that which all formulas will be used in this particular chapter. So as you all can just check, your cost of debt can be of two types, KD irredeemable and KD redeemable. So when in the question you see life of the debentures given to you or life of the preference shares given to you, then definitely we will be using KD redeemable. But guys, when this life is not available, we will be using your KD irredeemable part. Okay. Now what about your net proceeds? So sometimes in the question they will give you the information like this, that debentures were issued at market price of 110 rupees. Then your market price will become your net proceeds, or else sometimes the issue price will be specifically given to you. So that particular issue price you are going to take into consideration for your net proceeds. And guys, when none of this particular information is given to you, then whatever is the face value, that itself will be taken into consideration as your net proceeds for the purpose of calculation. Guys, when the life is given to you, we just have to check whether the redeemable value is available with us or not. If no information is given to you, we will always assume that the redemption is done at par, and also whatever is the life etc given to you, you will take that into consideration for the purpose of calculation of your KD. Okay. Same concept also applies for your cost of preference shares, but the only difference here is that whenever you are calculating KP, tax savings is not available on the preference dividend. Rather, if there is dividend distribution tax given in the question, then we have to take preference dividend into 1 plus DDT. Or else in all the questions we have also solved, there is no DDT, so we will be taking preference dividend upon net proceeds into 100. But remember that there is no tax savings applicable here. Guys, similarly, when we are going to consider your cost of preference shares which are redeemable in nature, the only thing which changes will be your preference dividend into 1 plus DDT rather than having interest into 1 minus tax, because as you all are aware that interest debited in the P&L account will reduce your profits and that will lead to tax savings. The same is not applicable for cost of preference shares. Then my dear students, let's talk about KE. Now to calculate KE, my dear students, you should have one basic objective in your mind, and the objective is that whatever will be the expectation of equity shareholders, that will become your cost for the company. So what is going to be your KE, my dear students? KE will be nothing but expectations of equity shareholders that will be treated as cost of equity for the particular company. Okay. So how do you calculate the expectation of equity shareholders? With the help of your different type of approaches. So guys, in all you have to remember 5 main approaches on the basis of which your KE is calculated, for which we have formulas. So guys, we have first of all your cost of equity by taking into consideration whatever is your dividend yield approach. So whenever we are talking about yield, your yield is your returns. So when we are talking about dividend yield approach, you have to revise like this, that whatever dividends you are earning on the equity share investment which is being made. And guys, for equity shares, always remember that market price plays a very important role. So that is why the formula for your dividend yield approach will be DPS upon MPS into 100. And guys, similarly when we have earning yield approach, so your KE will be having EPS upon MPS into 100. And guys, whenever we are calculating your dividend yield growth approach, then we'll be using your Gordon's formula, and your Gordon's formula will be D1 upon P0 into 100 plus G. Guys, similarly for earning yield growth approach, we'll be having the formula E1 upon P0 into 100 plus G. But guys, in all these 4 approaches, if they have given to you that new equity shares have been issued at market price and there is some flotation cost which has been subtracted, then for all the new calculations we will be taking into consideration net proceeds in the denominator. Okay. So for all the 4 approaches, instead of market price, net proceeds will be taken into consideration. So as you can just check, it is nothing but DPS upon MPS into 100 or DPS upon net proceeds into 100. So depending upon what kind of data is given in the question, we will be calculating the KE. Similarly for earning yield approach of also EPS upon MPS and EPS upon net proceeds. Then your dividend yield growth approach will have D1 upon P0 into 100, and this will be D1 upon net proceeds into 100. And guys, also at the same time, your earning yield growth approach will have E1 upon P0 into 100, and this will be E1 upon net proceeds into 100. So guys, this is how we'll be calculating your KE under these particular 4 approaches. Okay. Then my dear students, we have something which is called as realized yield approach as well. So for this, there are certain questions which are specifically given to you in the study module. So those value addition concepts, we'll be doing it, after we complete the revision of this JKC textbook. So at the end of the video, you will also find out, there are some questions on realized yield approach, which I've revised it from the study module as well. So guys, please make sure that you watch those particular questions as well, so that all your doubts regarding realized yield approach, etc., gets solved regarding the same. Okay. And it is needless to say that till now they have not asked the questions on these kind of approaches, but still we are going to cover the same in this particular revision series. Now my dear students, continuing further, we have something which is also called as your capital asset pricing model. And guys, your capital asset pricing model will be nothing but risk-free rate plus RM minus RF into beta. And guys, your RF means your risk-free rate, your RM will be your return on market portfolio, and beta is the sensitivity index which will be given to you in the question. Okay, so that's how your KE will also be calculated. Now my dear students, while talking about your cost of retained earnings, one basic thing you have to understand is your KR, your cost of retained earnings, will always be equal to your cost of equity, because your reserves and surplus belongs to equity shareholders. So whatever are the expectation of equity shareholders pertaining to equity share capital, the expectation of equity shareholders pertaining to your reserves and surplus are also going to be the same. But yes, there are also two exceptions to it, where your KE and KR will not be the same. Point number one, that whenever we will be calculating the KR, we will be subtracting the flotation cost. So my dear students, in that particular case, we will be taking your KE calculation will have D1 upon net proceeds into 100 plus G. So we'll be definitely subtracting your flotation cost for the purpose of calculation of cost of equity. But for cost of reserves and surplus, we never subtract flotation cost. So we always ignore the flotation cost. Okay. So share issue expenses are never taken into consideration while you are calculating your KR. But yes, your share issue expenses will definitely be subtracted while you are calculating your KE. So that is one of the difference which you have to understand. Okay. So for calculating your KE and KR, one thing you have to be very sure that if you see flotation cost, will we consider that for the purpose of calculation of KE? Yes. So market price minus flotation cost. But while calculating KR, will we be subtracting the flotation cost? Then the answer is no. We'll be just taking into consideration the market price per share. Okay. The next one, my dear students, is your shareholders' personal tax. Shareholders' personal tax we will always take into consideration while we are calculating your KR. So for the purpose of calculation of KR, we will take KE and multiply that by 1 minus shareholders' personal tax. So that is how your KR will be calculated. So if the shareholders' personal tax is given to you, what you need to do is you will calculate your KE as it is, and then whatever is your KE, you multiply that by 1 minus tax. So that will give you your KR. Because the logic is very clear here, that whenever this reserves and surplus, if it might be distributed to the equity shareholders by the way of dividends, and if the investment would have been made somewhere else, and that income was subject to tax, so we have to take their post-tax opportunity cost for the purpose of calculation of KR. So that's why we'll be taking KE into 1 minus tax. With this, my dear students, your all the approaches regarding your KE gets completed. And one thing which I want to conclude here is, while calculating your KR, be very sure that your KE and KR both are same until and unless we have two specific situations where, number one, if there is shareholders' personal tax, we have to consider that in KR, don't consider that in KE. And second, while considering your flotation cost, we will definitely subtract flotation cost while calculating KE, but ignore the share issue expenses, because share issue expenses are never incurred while reserves and surplus. So that's why we just have to take market price for the purpose of calculation of KR. Okay. Now my dear students, after all these things, let us first start with some of the questions regarding your specific cost of capital. Okay, let us revise these concepts first, and then we will be discussing your weighted average cost of capital. As you can see, the first question, which is a very basic question, you are just required to calculate your KD, and here the life is not given to you. So we will be using the formula KD is equal to interest into 1 minus tax upon net proceeds into 100. So my JKSC students, you all are aware about this, that when the life is not available, we all are going to take into consideration KD is equal to interest into 1 minus tax upon net proceeds. We have the face value available, we have the amount of the debentures which are supposed to be issued, we have the rate of interest available, tax rate is given to you. Of course, the net proceeds will change depending upon how are we issuing it, whether it is at par, premium or discount. So depending upon that, your number 1 KD will be calculated. Then my dear students, in this particular case, as you can see in the B part, if brokerage is paid at 2%, what will be the cost of debentures if the issue is at 10% premium? Now my dear students, here also we are going to consider net proceeds by taking whatever is going to be your issue size minus whatever will be your brokerage cost. So guys, here we are issuing it at 10% premium. So whatever will be your 10 lakh rupees, you will add 10% premium to it, and then we'll subtract the brokerage cost to finally get the net proceeds. Okay, so you can very well check this in your solutions. You have taken this into consideration. Okay, life is not available. Always remember that this will be irredeemable, this will be perpetual, and we are going to use interest into 1 minus tax upon net proceeds. Coming to question number 2, my dear students, this question we are required to calculate your KE. Okay, so we are quickly revising this. So guys, keep your material with yourself, and what will be the important concepts in every particular question, we'll be marking the same as well. Here in this particular case, you can just check that we are having here 2 types of equity shares. Number 1, which is nothing but existing, and number 2, which is nothing but your fresh issue. So as you can see that the market price is nothing but 50 and the company is expected to pay dividend. Now always remember that whenever you see such kind of wordings, expected to pay or proposed, so then we will always treat this as your D1. Okay, and guys, if suppose current year dividend or last dividend paid is given to you, then we will treat it as your D0, to which we have to add the growth rate. So now my dear students, we have the growth rate at the rate of 8% per annum, and your D1 is available, we have market price available, we have growth rate available. So it's very easy to identify that we will be using Gordon's model for the purpose of calculation of your KE. Now if you are issuing fresh shares, as you can see that the market price per share is rupees 50, but we are going to issue it at 1 rupee below the market price. So guys, your net proceeds will become 49, and also there is a cost which is involved for the purpose of issue pertaining to 50 paise. So that is why the net proceeds which the company is going to get will be 48.5. So guys, while calculating your KE new, just remember that in the net proceeds will be taking 48.5, and that's how your question number 2 KE will be calculated using your Gordon's model. Continuing further, in your question number 3, you all can just check that we are required to calculate your KD, and to calculate your KD, again these are irredeemable debentures, and guys, net proceeds is also available. Your calculation of interest will be on the face value. Your face value is 100 rupees, rate of interest is 12%. So guys, 12 rupees will be your interest into 1 minus the tax rate, which is 35%. But while calculating net proceeds, see, we are required to calculate the current cost of capital, and these debentures were issued 5 years ago. So guys, right now we just need to check what is the market price of the debenture, which is very well stated, and that's nothing but 94. So hence in the net proceeds we will be writing down 94, and that's how your KD irredeemable will also be calculated. Then my dear students, while calculating your KP, cost of preference shares, you remember that here in this particular question life is available. So we are going to use a bigger formula, which is nothing but PD plus RV minus NP upon N, the whole upon the average of RV plus NP upon 2 into 100. Okay, so that's how my dear students your KP will also be calculated, and you can calculate this on your per preference share basis or in totality. But I would always request you that whenever we'll be using the redeemable formulas, you calculate this everything on per share basis so that your calculations become easy. Then my dear students, from question number 5 onwards, here we are going to use the concept of weighted average cost of capital. So let me quickly revise what is weighted average cost of capital. That is nothing but your overall cost of capital. Now my dear students, always remember like this, that whenever we are going to raise finance from multiple sources, it is not necessary that we are going to raise it in the same proportion. We are going to raise it in different proportions and different weights. So in such a situation, when you are required to calculate the overall cost, it is very important for you to first understand that what should be the weights we should assign on the basis of which your overall cost will be calculated. Now, for example, if you want to calculate your, overall cost for a particular company which has three instruments in the capital structure: debt, preference shares and equity shares. Now, in this particular case, if you are required to calculate the overall cost, we need to check in what proportion this debt, preference shares and equity is being raised. Now, if you are using book value weights, as you all are aware, these are nothing but balance sheet values. So, we will be taking the weights from the balance sheet itself. It means that your amount column will have your balance sheets. And if you are using market value weights, then in that particular situation, whatever is your debt, preference share and equity share, will be first writing down the market values of all three financial instruments, and then we will be calculating the weights, and after that your overall cost will be calculated. So my dear students, you have to first understand the difference between your book value weights and market value weights. The difference is very clear, that while calculating the weights in the amount column, what should be taken into consideration. In book value weights, we will be taking the balance sheet values. In market value weights, we will be taking the market prices of every financial instrument. Now my dear students, if suppose there is long-term loans, and long-term loans will definitely not have any market value, so its book value itself will become your market value. So accordingly, we are required to prepare the table in which your amount column is extremely important, because it depends upon what type of weights you are using. If you are using book value weights, we'll take the items, we'll take the amounts from the balance sheet, and if it is market value weights, those items will be multiplied by the respective market prices, and on the basis of which your market value weights will be calculated. Now my dear students, in this particular question, the important concept here is regarding your ex dividend and your cum dividend. So guys, as you all are aware, your ex dividend price is also known as the current market price. So if any particular instrument cum dividend price is available, we have to first convert that into ex dividend price. And guys, in this particular question also, we are required to calculate WACC on market value weights. Now while considering market value weights, we will definitely be ignoring your reserves and surplus, because your market price of equity share will always be after considering the impact of your reserves and surplus. So that's why share premium, retained profits will not be forming part of it. But yes, equity share capital, 8% preference share and 13% perpetual debt. These three will be forming part of your components. And in this particular case, in your amount column, we will be having 50,000 shares, and equity shares, your market price is available as rupees 39. So ordinary shares are your equity shares. 50,000 into 39, that will give you your market value of equity. So while calculating, my dear students, the ex dividend price for preference shares, we just need to take what is the cum dividend price. Now the cum dividend price for preference share is 18 rupees. So we'll be taking 18, and from this 18 we'll be subtracting the dividend per share. And guys, your dividend per share will be nothing but the face value of 25 into 8%, so that will give you 2 rupees. So from 18, if you subtract 2, your ex dividend price will be rupees 16. So guys, also when you are calculating your KP, you have to be very careful that your preference dividend needs to be divided by your ex dividend price, which is nothing but 16 rupees, and that's how your KP will also be calculated. So my dear students, while calculating your KE, KE is readily available, nothing to worry. While calculating KP, life is not available, so we'll be definitely using your irredeemable formula, for the purpose of which we have to calculate your KP, and your KP will be calculated by whatever is your preference dividend, divide that by net proceeds, and your net proceeds, my dear students, will be nothing but market price. Okay, as I told you earlier also, that net proceeds will be treated as your market price, and on the basis of which we have to calculate your KP. For calculating your KD, you can just check that the debentures are selling at 110% ex interest. So in that particular case, the face value of the debenture is 100, its ex interest price will become 110, so that's nothing but the market price. And guys, here it is perpetual debt, so that's why we'll be using irredeemable. So KD will be interest into 1 minus tax. Interest is always calculated on your face value, and here your net proceeds will be replaced with your market value, and guys, your market value will be 110. So guys, this is how the three types of cost will be calculated. KE given, KD, your net proceeds will be nothing but market price, that is nothing but 110, and for KP, you will be dividing that by your net proceeds, which is nothing but rupees 16. Okay, So guys, that's how your KE, KD and KP will be calculated. And guys, market value weights, it's very easy to calculate the market values. We'll just take the number of shares, number of debentures, number of preference shares, simply multiply that by the market prices, and here your market prices are represented by your ex dividend prices or ex interest prices, and that's how your market value weights will also be calculated. But are we going to consider reserves and surplus? Then the answer is no. So guys, in this particular question, the only thing which you all need to revise one day before the examination is regarding the concept of ex dividend and ex interest. Continuing further, my dear students, your question number 6 is a very basic question regarding your calculation of KE using dividend yield growth model. Coming to question number 7, now this question, my dear students, was asked in your July 21 only, the same type of a question where the additional funds required is nothing but 10 lakh rupees, and guys, we have already 2,10,000 in the form of retained earnings. So guys, in this particular question, first we need to check that if you are raising additional 10 lakh rupees, what is the proportion? So your debt is 30, your equity is 70. So 10 lakhs into 30%, 3 lakh rupees will be your debt, 7 lakh will be your equity, and in that 7 lakh equity, you already have 2,10,000 by the way of reserves and surplus. So automatically your balance part will be your fresh issue. In this question, my dear students, your debt, your cost of debt will be calculated in a different way, because as you all can just check that 3 lakh rupees debt will have up to 1,80,000, the debt, the cost of which is 10% before tax, and guys, we need to convert this post tax definitely, so tax implications needs to be taken into consideration, and for the balance 1,20,000, the rate of interest applicable is 16%. So guys, in this question also your KE will be calculating with the help of your dividend yield growth approach, and that's how your KE will be calculated by taking D1 upon P0 into 100 plus G. Okay, so guys, your DPS is available as 2 rupees because 4 multiply that by 50%, to which you will add the growth rate, divide that by the market price, which is nothing but 44, and plus whatever is your growth rate. So that will help you to calculate your KE. And guys, in this question, these 4 things needs to be calculated. What is the pattern of raising additional finance, that is from which all sources we are raising your capital, what will be your debt, what will be your equity mixture, then what will be just the average cost of this particular 3 lakhs, you all need to consider that. Then what will be your cost of retained earnings and cost of equity. So here, as I told you, there is no share issue expenses, neither there is any shareholders personal tax. So your KE and KR both are same, my dear students. So that is why whatever is your KE, you are going to get with the help of dividend yield growth approach, the same you will be applying to your reserves and surplus as well. And then, my dear students, you are required to calculate overall cost, that is nothing but the cost of entire 10 lakh rupees. So this is how your question number 7 will be calculated. Now coming to question number 8. In your question number 8, this particular question I want you to revise one day before the examination. Here we have book value weights and market value weights both. So guys, in this particular question, we have 3 types of instruments: debentures, preference shares and equity shares. Now we have the face values available, and also at the same time we have market prices available. Now in this particular question, you all can just check that the debentures are redeemable at par. So guys, your KD will be calculated by taking interest into 1 minus tax plus whatever will be your redemption value minus net proceeds upon N, and divide that by the average of RV plus NP. In this particular question, my dear students, you have your face value of 100 rupees. The rate of interest is 10%. So your interest will be 10. You have the tax rate available in this question as 50%. Then your redemption, no information is given, or even if you are in this particular question, specifically they have told you that it is redeemable at par. Even if this particular sentence would not have been there, we would have redeemed the particular debentures or preferences at par only. So that will be 100 rupees. And for calculation of your net proceeds, you can take market price minus your flotation cost. Alternatively, you can also take face value minus the flotation cost. But as per the revised study module, we will be taking whatever will be your market price minus your flotation cost, and that will give you your net proceeds. So that's how your net proceeds will be calculated. So as you all can just check, 105 per debenture, that is nothing but your market price. Your flotation cost is 4%. So from 105, when you will be subtracting 4%, you will be getting the net proceeds. Life is nothing but your 10 years. So that's how your KD will be calculated. The same logic will also be applied for your cost of preference shares. So we will be always calculating the preference dividend on the face value. Redemption, here also it is mentioned, it is at par. And guys, your net proceeds will be 110 minus your 2% flotation cost. Alternatively, it can also be done like this by considering the percentage on the face value, but as per the revised study module, we'll be considering that on the market price. Life is also available as 10 years, and that's how your calculation of KD, KP, etc. will be done. And guys, while calculating your KE, we'll be using your dividend yield growth approach. In this dividend yield growth approach, you have to be very careful because your expected dividend is given to you. So we have the D1 available as 1. Your net proceeds will be 24 minus 4, that's nothing but 20. Your growth rate is 5%, and that's how your KE is required to be calculated. So guys, remember that whatever will be your KD, KE and KP, that is going to remain the same whether it is book value weights or whether it is market value weights. The only thing what will be different will be the proportions or weights. So in book value weights, we'll be taking 5 lakh, 5 lakhs and 10 lakhs, and we'll be treating this for the purpose of your proportions, and that's how the cost will be calculated. But for market value weights, we'll be taking whatever are your number of debentures, 5,000, multiply that by 105. Here we'll be taking 5,000 and multiplying that by 110, and here we'll be taking 1 lakh and multiplying that by 24. So that's how your calculations will be done regarding your market value weights. But whatever is your KD, KP, KE which you have calculated, that you are going to substitute whether it is book value weights or market value weights, and you will do it accordingly. Okay. So this question, my dear students, I want you all to just go through it once before your examination. Similar to this, now my dear students, we are going to revise this question number 9 as well. Now in this question number 9, here the question deals with optimum capital structure. So as you all can just check, what is the best or the optimum capital structure? Your debentures is 30,000. So it means your proportion of debentures is 0.15, your proportion of preference shares is 0.05, and your proportion of equity is 0.8. So guys, when you are going to raise any further funds, you have to compulsory raise in this particular proportion only. So guys, we have the optimum capital structure available to us in the question. So whenever any new additional finance needs to be raised, then it has to be raised in this particular proportions which you can see right now. So your debt will be 15%, your preferences will be 5%, and your equity will be 80%. In this question, my dear students, growth rate is not directly given to you. So that's why you have from past 10 years some earning per share available. So on the basis of the data given to you, first we will calculate what is the growth rate in your earnings, and that growth rate will be applying for the purpose of calculation of your KE. Guys, here they have specifically told you that the debentures will be issued at the market price, which is nothing but rupees 96. So in this particular question, my dear students, okay, some few things which we need to discuss here. Number one, you are required to calculate cost of new debt. Guys, we are required to calculate cost of new debt. So the debt which is there in the capital structure, we are not concerned with that, but the new debentures which we are issuing. So the new debentures which we are issuing at the market price of rupees 96, and guys, 16% is the rate of interest. So whatever is the face value, will multiply that by 16%, will be getting the interest. Will be multiplying that by 1 minus tax rate and divide that by your net proceeds, which will be nothing but rupees 96, multiply that by 100. So that will give you your KD. For calculation of KP, same concept is applicable. Your annual dividend here will be 1.1, which you will divide it by the market price, which is nothing but 9.2 into 100. That will give you your KP. And guys, for calculation of your KE here, we are going to take into consideration retained earnings. So that is why here the calculation will be done by taking whatever is your next year's dividend, and that next year's dividend will be 50% of your EPS. So 2.36, multiply that by 50%, so that will be 1.18, and that is your next year dividend. Okay, so that's already your D1. You will be dividing that by the market price, which will be 23.6, and you have to add the growth rate, and this from the past year trends, you will realize that the growth rate is nothing but 10%. So that's how your KR or your KE will also be calculated. Then my dear students, in the B part, they have asked you that what will be the marginal cost of capital when no new shares are issued. So guys, now you are required to calculate overall cost of capital. So when we are not issuing any new shares, it means that we are using retained earnings, and retained earnings also belongs to equity shareholders. And what is the optimum weights of equity shareholders? Then that optimum weight is nothing but 80%. So guys, here we are going to have, your debentures, preference share capital, and your reserves and surplus, the weights of which will be 0.8, your debentures is 0.15, and your preference shares is 0.5, and whatever cost we calculated in the A part will be multiplying with this, and the final answer will give you your overall cost of capital. Then my dear students, in your C part, you are required to calculate how much can be spent for capital investment. So guys, if suppose we are just using retained earnings as a source for the purpose of calculation or for the purpose of expansion, then if that particular reserves and surplus will be used for the purpose of expansion, we are not going to issue any further new equity shares, then what will be the total capital investment which you can raise? Now very well you can see in this particular question, you have your EPS of 2.36 and 50% you are going to distribute by the way of dividends. Your retention will be 1.18, which needs to be multiplied by the number of equity shares, that is 10,000. So guys, you have your reserves and surplus of, you have your retained earnings of 11,800, and guys, then this particular retained earnings will be nothing but forming 80% part. So you simply need to gross it up to check that what is going to be your amount of capital investment. So 11,800 will be your reserves and surplus. You will simply divide that by your 0.8. You will be getting the total capital investment which is supposed to be raised. So once you get the total capital investment available, my dear students, then this total capital investment needs to be taken into consideration for the purpose of expansion. And in this total capital investment, we have not issued any further equity shares, but yes, we are using reserves and surplus, whatever is the retained earnings, we are using that, and your issue of debentures and preference shares will be done at the market price, and that's how your marginal cost of capital will be calculated. While considering D part, my dear students, if you want to raise the fund which is exceeding the amount calculated in C above. So right now also, my dear students, you can calculate, you can take 11,800 and divide that by your 0.8, you will be getting 14,750. So this 14,750 you can raise it by the way of your new debentures, new preference shares, and your reserves and surplus. But if you want to raise anything above 14,750, then your reserves are now exhausted. So that's why now you have to compulsory go for your fresh issue of equity shares. So for that, my dear students, they have told you that there is an issue at ₹20 per share. So guys, you have to calculate your new KE by taking D1 upon net proceeds into 100 plus G, and your net proceeds here will be nothing but ₹20. Okay, so this is how your calculation will be done. So my dear students, in this particular question also, your C and D part, this is something which you can revise one day before the examination. Whatever is your C and D, so you can just put a star mark here. So how do you calculate your KE, KR in this particular question? Then what should be the optimum capital structure? All these things are important pertaining to your question number 9. Now my dear students, coming to question number 10, a very easy question. Past year dividends are given to you, and whenever past year dividends are available, these are growing at a constant rate. So we have the growth rate available. So you can calculate KE using dividend yield growth approach. In question number 11, your past year dividends are given to you, but they are not growing at a constant rate. So we need to take the average growth rate here. Okay. And on the basis of which you have to calculate your KE existing as well as KE new. The difference here will be for KE existing, as we have revised, you will be taking market price, and for your KE new, you will be taking net proceeds. Question number 12, my dear students, here will be having your calculation of your growth rate with the help of your retention into ROE. So whatever will be your retention, you multiply the same with your ROE, and that's how your growth rate will be calculated. Your ROE is nothing but 20% and your retention will be 60% because your payout is 40. So 0.6 you multiply that by 20%, so that's how your growth will be calculated. Question number 13, here my dear students, if you want to calculate your KE, so to calculate your KE, in this particular case the growth rate will be calculated by using the formula EPS minus DPS upon market price per share. And guys, whenever you want to calculate the growth rate for your new equity shares, it will be EPS minus DPS, and this we are going to divide it by net proceeds. Okay, so that's how, my dear students, your retention needs to be divided by market price and your retention needs to be divided by your net proceeds for the purpose of calculation of your KE. So always remember that first you will calculate the growth rate here, and to calculate your market price, your P ratio is given to you, so you can simply take EPS, multiply that by your P ratio. So that's how your market price will be calculated. And from that market price, you need to subtract your flotation cost, if any, and your flotation cost is 10% of your issue price, and that's how the net proceeds will also be calculated. So guys, this is regarding your calculation of growth rate on the basis of EPS minus DPS upon market price or upon net proceeds. Now, my dear students, question number 14, this question has one thing important, that is how do you calculate your KE part. So here also, as we have just now revised, that how can we calculate your growth rate when your EPS, DPS and market price, or EPS, DPS and net proceeds are available. So the same thing will be applied here for the purpose of calculation of your growth rate. So this is something which you have to understand. So in this particular question, your bank loan short term and your trade creditors, this will not be forming part of your weighted average cost of capital. Okay, but yes, definitely from equity share capital to your bank loans long term, this will be forming part of your weighted average cost of capital. And that also, my dear students, while calculating your KE, you have to be careful that these are 60,000 shares and these are your 40,000 shares. So here we have KE old also, and we will be having your KE new also. So guys, both will have different components of growth and both are going to have the different market price and net proceeds on the basis of which your KE old and KE new will be calculated. Guys, in this particular question, calculation of your KP, KD, etc. is extremely simple. 14% short term loan is of absolutely no use to you. And guys, we have market values available of preference shares and debentures. Guys, the best part about this question is they have not mentioned that you need to calculate your weighted average cost of capital using what as weights. But we have the market price available for preference shares also, and we have market price available for debentures also. So in this particular question, we are required to calculate your KD, KP, etc. and we are required to calculate your WACC using your market value weights. Okay. So guys, when no information is available but the market price of financial instruments are given to you, then definitely market value weights will be taken into consideration. Then, my dear students, in your question number 15, this is a classic question on your capital asset pricing model. So you can just put a star mark here, and in this particular question you are required to calculate your equilibrium price of the share. Now, to calculate your equilibrium price per share, we can just write down the dividend yield growth approach, but this time with an intent to calculate your P0. So your P0 will now become D1 upon KE minus G, and guys, you will be having your dividends as last year dividend is 4 rupees, and we have the growth rate also available, which is 8%, and also at the same time the K is available as, in this particular question, K is not given to you directly, but you can calculate this with the help of capital asset pricing model. So your KE will be risk-free rate plus RM minus RF into your beta, and you have your risk-free rate available as 10%, your return on market portfolio is 15%, then your beta is nothing but 1.4. So this will actually help you to calculate your KE, and guys, your growth rate is nothing but 8% given to you, and that's how your P0 will be calculated. Guys, once you have the equilibrium price, also known as intrinsic value, this P0 is available, and guys, the current market price of the share is rupees 36. So if you have your P0 available, equilibrium price, and you have the current market price, we can just compare it and check whether it is underpriced or overpriced and what should be done, whether you should invest or not. Okay. So guys, accordingly, first we have to calculate the P0 equilibrium price using Gordon's model, but your K is not given to you, but data regarding your K is available with the help of CAPM. We can calculate your K and then accordingly find out the value of share and compare that with the actual market price to check whether investment should be made or not. Question number 16, my dear students, even if you don't do it from the examination perspective, it's okay. Coming to your question number 17, you are required to calculate the weighted average cost of capital with the help of your book value weights and market value weights. Okay. In this particular question, we are having equity capital, we are having preferential capital, retained earnings, 13% loans and 15% term loans. Guys, your first of all your KE will be calculating using dividend yield growth approach. As you can see that D1 is available to you, growth rate is given to you and market price is 40. Preference shares, my dear students, these are redeemable, okay, after 10 years and it's currently selling at rupees 75 per share. So just make sure, my dear students, while calculating your KP, you take your net proceeds as rupees 75, and same applies for your KD as well. Your redemption will be done at par. See here, in this particular question, they have not given you that redemption will happen at what price. So it's definitely going to happen at par. And guys, your net proceeds will be nothing but your selling price, which is rupees 80. So that's how your KP and KD will also be calculated. Your KE will be calculated using DYG approach, and you are required to calculate your WACC using book value weights and market value weights. Guys, if you are calculating your WACC using book value weights, you will be taking all these things into consideration and weights will be formed. Your KE is equal to KR, so nothing to worry. Whatever is your cost of equity, that will be applicable to your cost of reserves and surplus also. But while doing market value weights, we will be ignoring your retained earnings because your market price of equity share is always after considering the impact of your reserves and surplus. So whatever is going to be your market price per share, which is nothing but 40, we will be multiplying that by the number of equity shares to calculate the market value of equity. Then you have preference shares ka market price also available by taking 75, and then for debentures market price you will be taking 80 rupees. So that's how. For term loans, your book value itself will be your market values, will be having the market value weights, and whatever cost you have calculated, the same will be applicable for your book value as well as for your market value, and that's how you will be calculating your final answer. Then my dear students, pertaining to your second point, you are required to calculate your weighted average marginal cost of capital. Now in this particular case, you have rupees 10 crores, and guys, we have to raise this particular 10 crores through different sources, and here we have debt and equity, and that is in equal proportion. So guys, whatever we had discussed regarding that Masco Limited question, the same thing applies here. You have to calculate your KD, KE, etc., and then accordingly we have to calculate whatever is going to be your marginal cost of capital, the cost of just this 10 crore rupees. Okay, so this question, my dear students, you all can just ignore revising this one day before the exam, because already the parts of these questions we have already taken into consideration in the other questions as well. Coming back to question number 18, my dear students, in this particular question, you can just go through this particular question once. Here, the KE first of all is calculating using your capital asset pricing model. So just make sure that while calculating your KE here, we will be using your CAPM approach. So we are having the market price per share of rupees 60. The risk-free rate available is 5.5%, and your average market risk premium. Guys, whenever they use such kind of wordings, that is market risk premium, it means that your RM minus RF is taken into consideration. So market risk premium means what, my dear students? RM minus RF. So this will be your market risk premium. So we need to now multiply this 8%. We need to multiply it by beta of 1.1875. So guys, don't treat this as your return on market portfolio. This 8% is nothing but RM minus RF. That's nothing but just your premium part available. You need to multiply it by 1.1875 and add the risk-free rate to it, and that's how your KE will also be calculated. Okay. So guys, in this question, the preferred stock or the preference share is available. These are also redeemable, and it is currently selling at rupees 98.15. So we have the net proceeds available also for the same. We are required to calculate the WACC using market value weights. So guys, while calculating market value weights, just make sure that we will be taking into consideration your equity shares, preference shares, debentures, term loans. Your reserves and surplus will definitely not come, because your market price of equity share is after considering the impact of same, and here your KE is calculated using your CAPM model. Okay. Then my dear students, in the second part again, we have marginal cost of capital concept. So here we just have to calculate the cost of this additional funds, that is 750 million, with having the same proportion, that debt will be 20% and then your equity will be 80%. So this will be 150, this will be 600. And how are you raising this 150? So that is 100 and 50, and that's how your cost calculation will be done. Okay. So your, my dear students, your KE will change because your beta of the new project is 1.4375. So your KE will be calculated by taking risk-free rate plus that market risk premium. Okay. So that was already RM minus RF available, which will multiply it by 1.4375 to calculate your KE part. Okay. So that's how, my dear students, your overall cost of capital will be calculated. And with this, my dear students, we can put it in this words that your cost of capital chapter, which deals with your type 1, that is specific cost of capital, and your type 2, that is weighted average cost of capital, that gets revised here. And now from the next question onwards, we will be revising your capital structure theories. So we are considering capital structure theories as a part of cost of capital. In your study module, you will find this in your capital structure chapter. Okay. So now we will be revising your capital structure theories. Now in this capital structure theories, my dear students, as you all are aware that we have different approaches. First one is your net income approach. Then, my dear students, we have the second part, which is nothing but your traditional approach. Then, my dear students, we have the third part, which will be your net operating income approach. And then we have the fourth part, that is your approach. Now, my dear students, when we are talking about net income approach and traditional approach, always remember that these two theories are of the view that if you change the capital structure, then your WACC will also change. And guys, in your NOI and approach, if you change the capital structure, then your WACC is not going to change. Okay. So this is something which you have to understand broadly about these four theories, that when we are talking about NI approach and traditional approach, any changes in the capital structure is going to have an impact on WACC, yes or no? Yes, sir. But when we are talking about NOI approach and approach, even if you change the capital structure, your KO WACC is going to remain the same. Now these capital structure theories, my dear students, these are based on certain assumptions. That is, number one, that there is going to be no preference share capital, there is going to be no income tax, and there is going to be no retention. So 100% dividend, 100% earnings will be paid by the way of your 100% dividends. Okay. So guys, we have to understand that there are certain set of assumptions which are common for all the types of theories. Okay. Now when we are talking about question number 19, this is regarding your NI approach. And in your net income approach, the concept is that if you change the capital structure, if you are introducing more debt in the capital structure, then your K is going to remain constant, and your more and more introduction of the debt in the capital structure will definitely reduce your KO. And guys, when your KO will be reduced, then the market value of the firm is definitely going to increase. So guys, whenever your more and more debt in the capital structure has been introduced, then what is going to be the impact of the same? That your K is going to remain constant, because of which your KO will fall and the market value of the firm will rise. So guys, we have your EBIT available here as 2 lakhs, and guys, from this particular amount of rupees 2 lakhs, we will be subtracting the interest component and we will be getting the EBT, and this entire EBT will be nothing but your dividends. So your EBIT is nothing but rupees 2 lakhs. Then when we are talking about your interest, then this will be 8 lakh into 10%, that is nothing but 80,000, and this will be your 1,20,000. Okay. And guys, when we are talking about your value of the firm, how will you calculate your value of the firm? That will be nothing but market value of your equity plus market value of debt. Your market value of equity will be nothing but whatever will be your dividends. Guys, will be capitalizing this by KE. That's how your market value of equity will be calculated. So guys, your market value of firm is nothing but market value of debt plus market value of equity, and don't forget this, your market value of debt will be nothing but whatever is the book value of debt, that's nothing but the market value, so which will be nothing but 8 lakh rupees. And while calculating your market value of equity, we will be taking the dividends and will capitalizing that by KE, and guys, your KE is nothing but 12.5%. So this will be giving you the market value of equity. To this you will be adding the market value of debt, and together you will be having the market value of the company. So that is something which we have to calculate in the first part of the question. and in the second part you are also required to calculate the overall cost of capital. So guys, how will you calculate your KO? You will simply take your EBIT and divide that by the total market value of the company. You will be getting your KO as well. Okay, so this is something regarding your NI approach. Continuing further, the next question which we have, that is on NOI approach. Now in your net operating income approach, we have to understand that even if you change the capital structure, then your WSEC is going to remain constant at all levels of capital structure. So in this particular approach, your KE will increase, your KE will rise, and your KE will increase in such a way that your KO will be remaining constant. So whatever is the benefit of cheaper debt, that will be compensated with the rise in KE, and your value of the firm will remain the same at all levels of debt in the capital structure. So guys, in this particular case, we are having the debt up to the extent of 20%, 35% and 50%. So guys, in this particular case, the total requirement is 20 lakhs. So the first of all, you have to understand that in this 20 lakh rupees, in the first case, your debt, which is nothing but 20%, so that will be nothing but 4 lakh rupees. In the second case, your debt is 35%, which is nothing but 7 lakh rupees. In the third case, your debt will be 10 lakhs. Okay, so this is how you are going to prepare the structure. And guys, also at the same time, your EBIT is going to continue at rupees 4 lakhs. So EBIT will be rupees 4 lakhs. To this 4 lakhs will be subtracting your interest. So we will be getting your EBT, which is nothing but your dividends. And now my dear students, your interest is going to be at the rate of 8%. So whatever is your debt, 4 lakh, you will multiply that by 8%. So that will be nothing but 32,000. 7 lakh multiplied by 8%, that will be 56,000, and 10 lakh multiplied by 8%, that will be 80,000. So this will actually give you your EBT or dividends. And guys, in this particular case, we are going to use NOI approach, and your risk class is 10%. So whenever such kind of wordings are given to you, it means that the company belongs to the risk class. It means that the company's overall cost of capital is nothing but 10%, which is going to remain constant at all levels of debt. So in this particular case, what will be the market value of firm? So here you will calculate your market value by taking whatever is your EBIT, and that EBIT you will divide that by KO. So your EBIT is nothing but 4 lakhs and your capitalization rate is nothing but 10%. So now this will give you your market value of the firm, which is nothing but 40 lakhs, 40 lakhs and 40 lakhs. Guys, from this, if you subtract the debt component, which is 4 lakh, 7 lakh and 10 lakh, you will be getting your market value of equity. So that will be nothing but 36 lakhs, 33 lakhs and 30 lakhs. And then guys, we are required to calculate your KE. And how will you calculate your KE? Whatever will be your dividends, you have to divide that by market value of equity. So your KE will be dividends upon market value of equity into 100. And guys, we have the dividends available for the first case, second case and third case, and that's how your KE will be calculated. And guys, your KE will be increasing in such a way that your benefit of cheaper debt gets compensated with the rise in your KE. So your market value of the firm is going to remain the same at all levels of debt. Your KO will be the same at all levels of debt. Your KE will increase, yes, which is unlike your NI approach. So in your NI approach, what was happening? That the KE was kept constant at all levels of debt. In this particular case, your KE is increasing in such a way that your benefit of cheaper debt gets compensated and your KO and your value of firm remains the same. Then my dear students, we have the next question in which we are going to use traditional approach. You all can just check that the KE is increasing 12, 12.5, 13.5, 15 and 18. And guys, here we have the EBIT available. These are the components of debt and this is your KD. So on the basis of this, we'll be getting your, whatever is going to be your EBT or dividends available. So guys, your EBIT will be 3 lakhs at all levels of capital structure, from which the interest component will be changing. Okay. So you'll be getting the EBT or dividends. Now guys, here your KE is increasing. We have to select the best capital structure. So guys, this is your traditional approach. Here the best capital structure will be the structure in which your overall cost is going to be minimum. So remember this particular concept, that if you want to calculate your KO, so this KO will be calculated by taking EBIT upon market value of firm into 100. And guys, how will you be calculating your market value of the firm? Your market value of the firm will be market value of equity plus your market value of debt. Guys, your market value of equity will be whatever will be your dividends, you will be capitalizing this by KE. So we'll be getting the market value of equity, we'll be adding the debt component to it. So we'll together have market value of firm, and with the amount of EBIT, we'll be dividing that by market value of firm into 100. We will be getting the KO. So KO will be available for capital structure 1 to 5. Okay. And guys, we'll be selecting the KO in which it should be least as possible. So you will select the capital structure in which your KO will be minimum. Okay. Now, my dear students, your question number 22, 23, this deals with your questions on approach. And for your approach, as you all are aware that we are going to use the concept of arbitrage to calculate the same. So I'll just revise some basic concepts about your here. First of all, you have to understand that approach can be of two types, without tax and with tax. So first, let us discuss about without tax. Now in this without tax, you have to understand that as per value of firm will be constant and your KO will also be the same because of arbitrage process. So first of all, what you have to remember in your without tax is that if suppose there are two types of companies, one is your levered company, another is your unlevered company. Levered company will definitely have debt in the capital structure, unlevered company will not have debt in the capital structure, there will be only equity company. And if you prepare the income statement by taking EBIT minus interest, you will be getting your EBT or your dividends. Okay. And then guys, we have to calculate whatever is your market value of equity, which will be nothing but dividends upon KE, to which we will add market value of debt, which will be nothing but book value of debt is your market value. And then you will be getting the market value of firm. Now guys, this particular format you can use for any question. Okay, we are talking about without tax. Okay, to understand first what is the market value of the firm for levered company and unlevered company, so that we can come to know that which company is overvalued and which company is undervalued. So guys, let's say for example for this particular question only, let us take this example, question number 25, in which you have your EBIT as 20,000 rupees. So we will take EBIT of 20,000 for levered company as well as for unlevered company. Then we have debt in the capital structure 1 lakh and the rate of interest is 7%. So this will be 7,000, and for unlevered company there is no debt in the capital structure. So this will be 13,000 and your unlevered company will have 20,000. What will be your market value of equity? It will be nothing but your dividends and you have to divide that by KE. So your cost of equity for N is 10%, for M is 11.5. Now N is your unlevered company, M is your levered company because M has debt in its capital structure. So we will simply take your dividends, which is nothing but 13,000, and divide that by your 11.5%. So this will help you to calculate your market value of equity, which is nothing but 1,13,043. And to this guys, we will add the market value of the debt, which is nothing but 1 lakh. So guys, this will be nothing but 2,13,043. And when we are talking about unlevered company, you have only dividends which is 20,000 and you will be capitalizing that by your KE, that is 10%, which will give you 2 lakh rupees, and there is no debt in the capital structure at all. Okay. So in this particular case, you all can see that your levered company has a value which is more than the unlevered company. So levered company N has a higher value as compared to your unlevered company, which is M. Okay, so levered company is M and your unlevered company is your N, and guys, your M has more value as compared to your unlevered company N, and therefore you have to shift your investments from your levered company to your unlevered company, and for sure you will earn some profits. Okay, so guys, in this particular question you have understood that your M has a higher value as compared to N. The same format you can apply it for the next question as well, which is your question number 26, and here also we have debt value available and then we have the rate of interest also available. We have cost of equity available as 10 and 18, and we can calculate your market value of the company for levered as well as for unlevered. And in that particular question, your market value of unlevered company will be more as compared to the market value of levered company. So you have to shift your investments from unlevered to levered. Here, my dear students, you will shift your investments from your levered company to your unlevered company, and while doing the same, you will earn some arbitrage profits. So what will happen when you will shift your investment? See guys, in this both the questions, they have given you no information regarding how much percent stake that particular investor had. So you can assume, let's say for example, Mr. X has 10% stake in the overvalued company, and you want to shift from your overvalued to your undervalued company. So in that particular case, what will happen? That now you will start receiving your dividends from your unlevered company, okay? And when you will be receiving your dividends from your unlevered company, in this particular case for special, and you will be subtracting whatever is going to be the interest cost, because you have to take some amount of loan, okay, and which will be in the same proportion of your levered company, and you will be paying the interest on the same. The rate of interest will also be the same, and whatever is your net amount, you will be subtracting your opportunity cost, and that's how you will be getting the final arbitrage profits, which means that you can shift your investments from levered to unlevered company. For sure you will be earning profits. And guys, similarly, when you will be shifting it from your unlevered to levered, then you will be providing with the loan, so interest will be treated as your income here, and the total amount which you will be getting from the levered company, if you subtract it from your opportunity cost, that is dividend loss from your unlevered company, you will for sure earn some profits, and that will be called as your arbitrage profit. So guys, you can also solve this alternatively without calculating arbitrage profits as well, by developing some surplus amount. That is, you can think like this, that you can maintain the same level of stake when you are shifting your investments from levered to unlevered, maintain the same level of stake, invest the same amount, have some surplus with you. Your arbitrage profits will be zero, but definitely that surplus will be available. That's how in the study module also they have solved it. But there are certain examples in study module which deals with your arbitrage profits as well. So I am covering that concept as well in this particular question. So here you can invest the full amount. Your percentage stake will be higher when we will be shifting from levered to unlevered in this first question of your approach. And in this particular case, whatever is your extra dividends you are earning after subtracting interest will surpass your opportunity cost of your dividends, and that will for sure give you some profits, okay? So guys, that's how what will happen is, people with the urge to earn some arbitrage profits will start selling your overvalued company stock, and they will be investing in undervalued company. So overvalued company stock will tend to fall, undervalued company stocks will tend to rise, and ultimately there will be a point where value of both the companies are going to remain the same. So says that value of company is going to remain constant irrespective of the capital structure, because wherever the investors are going to see the arbitrage profits opportunity, they will start shifting their investments from overvalued to undervalued, and they will for sure earn some profits, okay? So that is something which we are going to do in your question number 25 and 26. In question number 25, you have to remember that in this particular question, your levered company value is more than your unlevered company value, and in this particular case where you have two companies, unlevered and levered company, here your levered company value is less than your unlevered company. So basically you are going to shift your investments in question number 25 from levered to unlevered, and in question number 26 we will shift our investments from your unlevered company to your levered company, and for sure you will earn some arbitrage profits, okay? So that's how you can do pertaining to your question number 25 and your question number 26. Now my dear students, for your question number 22, it's a very easy question. Here we just have to calculate what should be the market value of the firm A and B, so which you can take it with the help of your equilibrium value will be nothing but your whatever is your equilibrium EBIT. So whatever is your equal EBIT, you will divide that by your equilibrium KO, which is nothing but 9.09%, and that's how you will be getting your equilibrium value of the firm, okay? Now question number 23, 24. Okay, so among your question number 25 and question number 26, you can revise one question one day before the examination. And between your question number 23 and 24, now this is regarding your with tax hypothesis. So in this particular question, basically here, whatever is your market value of levered company, that will definitely be more as compared to the market value of unlevered company. Your market value of levered company will be nothing but market value of unlevered company plus debt into your tax rate. So that's how your market value of levered company will be determined. So in this particular question, as you can see, there are two firms P and Q. P does not have any debt in the capital structure. So your P is nothing but your unlevered company. And how will you calculate the market value of your P? You will simply take your dividends and you will capitalize that by KE. You will be getting your market value of equity, which is nothing but market value of firm for P Limited, because it does not have any debt in the capital structure. And guys, when we are talking about Q, what we have to do is EBIT minus interest EBT. For Q, you have to remember that whatever is the market value of P plus whatever will be your debt into tax rate, that will actually give you the market value of Q. Okay, so that's how we have to calculate the market value of both the companies. So question number 24, now this you can revise one day before the examination. In this particular question, first RES was an unlevered company, so it only had equity in its capital structure, and then it takes debt in the capital structure. So you have to calculate, after taking debt in the capital structure, what will be the market value of RES, what will be your KE, and what will be your WACC. So guys, to calculate your market value of RES Limited, first what we need to do here is we have to prepare the income statement, EBIT minus interest, you will be getting EBT. Don't forget to subtract tax, because now this is hypothesis with tax. So you will be getting your EAT, also known as your dividends. And first we will write down RES, which is an unlevered company. Then we will be considering RES, which is nothing but your levered company. Okay. And in this particular case, we have your market value of equity, which is 25 lakhs, and K is 21%. So 25 lakhs into 21% will actually give you 5,25,000, which is nothing but this particular dividends. We have to go reverse. Okay. Now guys, the tax rate is nothing but your 30%. So if this is 100, this is 30. So this will be 70. So let us calculate what will be your EBT. So we have to calculate your EBT, which will be nothing but 7,50,000. And guys, because there is no interest, your EBIT will also become 7,50,000. So this will become 7,50,000. And regarding your interest, you have debt in the capital structure. And what will be your debt? Your 5 lakh rupees is the debt. So then we'll be subtracting the interest part. So your interest will be nothing but whatever is your debt, multiplied that by rate of interest, you will be getting the interest amount, subtract tax, and then you will be getting the dividend. Okay. Now what is required to be calculated? Number one, market value of RES Limited after the restructuring takes place. It means that after you have taken debt in the capital structure. Now in this situation, my dear students, we have to first know what is the market value of unlevered company, and to that we will add debt, multiply that by your tax rate. So in this particular case, we have debt. Okay. In the first case, market value of your unlevered company is nothing but 25 lakhs. Then you have debt in the capital structure, which is 5 lakhs, and you will multiply that by the tax rate. And that's how your market value of RES Limited after capital restructuring will be taken into consideration. To calculate your cost of equity, that is nothing but KE, after your restructuring process, you will be having your dividends here. Okay, after you prepare this income statement, you will be having your dividends. Simply take your dividends and divide that by market value of equity into 100. So what will be your market value of equity? You will be having your market value of RES Limited after you have taken debt in the capital structure. What is the market value of RES Limited? From that you will subtract the market value of debt, which is nothing but 5 lakhs. So you will be getting the market value of equity, that you can put it in the denominator. You have the dividends available. Divide that by market value of equity, multiply that by 100, you will be getting your KE. Also, my dear students, you are required to calculate your WACC. So your weighted average cost of capital, you are now having debt and equity in the capital structure. we are having market value of debt as 5 lakhs, we are having market value of equity here 21 lakh 50,000, and then we have KD and KE both available. So that's how your WACC will be calculated. Okay. So guys, this is regarding your hypothesis with tax. Now in your capital structure theories, as I have told you that you can go through question number 19, go through question number 20, go through question number 21, because these three are of three different approaches. Then you can just revise question number 24 for hypothesis with tax, and between 25 and 26 you can just revise question number 25, which is transfer from levered to unlevered company and concept of arbitrage process. So this is how you can approach your capital structure theories. So with this, my dear students, we have completed the revision, as fast as possible in the least possible time, covering maximum concepts as possible from my end. And your cost of capital, we have revised all the three questions pertaining to your, first of all, specific cost of capital, then WACC, and then your capital structure theories. Now my dear students, I want to start with your cost of capital, some value addition questions which are there in your study module. So we'll be referring to those concepts. I will try and solve, as much as possible from that as well. So you can keep your notebooks handy, and we'll be revising, we'll be going through the concepts, because these concepts which we can only approach in cost of capital will be after your capital budgeting chapter is being done. So the moment you know the concept of IRR in your capital budgeting, we can approach yield to maturity or YTM in this cost of capital chapter. Similarly, your realized yield approach and your realized yield growth approach, etc., everything we can approach it only after your capital budgeting chapter is being done. So now we'll be revising those concepts after your capital budgeting chapter is being already done. So we can now revise those concepts now. So I'll try to solve some of the questions out of the same. So you can do that along with me as well. Okay. So let's get started now with that particular concepts. So okay students, now let us continue further with these cost of capital, some value addition questions. Now guys, these questions you will find in your study module, and while revising these questions I have also given you the reference where will you find it in the study module. So before you start revising these particular questions, make sure that your capital budgeting concepts regarding your IRR, etc., are clear, so that it will be very easy for you to understand these kind of questions. So starting with your question number 1, see what is given to you. Institutional Development Bank issued 0 interest deep discount bonds of face value of rupees 1 lakh each, issued at rupees 2,500 and repayable after 25 years. Now we are required to compute the cost of debt if there is no corporate tax. So guys, this particular question relates to concept of how to calculate cost of a zero coupon bond, okay, or a deep discount bond. So basic characteristic of these bonds are that there is no interest which is being declared by the particular company. No interest is there on such kind of bonds over the entire holding period. So an investor is only going to get benefit at the time of redemption, when the maturity amount will be tremendously high as compared to the amount of the investment which is going to make today. So here, as you can just check, the present value of the bond is 2,500, and at the time of the maturity an investor is going to get 1 lakh rupees. So guys, from 2,500 to 1 lakh, whatever is the difference, that will be the capital appreciation, or that will be the benefit an investor is going to get. So whatever is the return for an investor, can I say that is nothing but the cost for the company? Come on, yes or no? Yes sir. So here in this particular question, we are exclusively going to deal with how to calculate the cost of a zero coupon bond. Okay, so you can just write down along with me, okay, or else you can just do the calculations while watching these particular videos, and these particular questions will have calculation of the cost, etc., with the help of your IRR, with the help of trial and error method and stuff like that. Okay, so first of all, for a zero coupon bond, we have the present value available of the bond, which is nothing but rupees 2,500. So you are going to invest rupees 2,500 today, and your future value, or at the time of maturity, you are going to receive 1 lakh rupees, and the life of the bond is 25 years, and we are required to calculate the return or the rate which an investor is going to earn which is nothing but the cost of debt for the particular company. So guys, we can use the concept of compound interest formula. So what is your compound interest formula? As you all know, it's nothing but amount is equal to principal into 1 plus r raised to the power n, or else we can also write down this as future value, because amount will be received in future. So future value is equal to P is your principal present value into 1 plus r raised to the power n, which is nothing but 25 years. Guys, your future value is nothing but 1 lakh rupees. Your present value of the bond is 2500 into 1 plus r raised to the power 25. So this will give you 40 is equal to 1 plus r raised to the power 25. So now with the help of trial and error method, we will find out that at which rate raised to the power 25 gives you 40. So now using trial and error method, let us start with approximate, let's say 15%. So using trial and error method, let us try at 15% rate. So this will now become 40 is equal to, let us try at 1 plus 0.15 raised to the power 25. Are we getting 40 or not? Okay. So you can do the calculations with me. So this will be actually nothing but, we want this particular part to be 40. Okay. So we want 1.15 raised to the power 25 to be 40. If that is the case, then 15% is the rate at which an investor will invest in the zero coupon bond at 2,500, and he is going to get 1 lakh at the time of maturity, and whatever is the return for an investor, that becomes the cost of debt for the particular company. So in this particular case, we can simply take 1.15 raised to the power 25 and check that what is the figure which is coming here. 1.15 square 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25. So guys, this will give you 32.92. So guys, we can put it in this words that 15% is actually not the rate at which your compounding figure will come as your, or you can also put it in this words that your future value interest factor comes as 40. So this is actually coming as 32.92. So now let us try add some another rate and check whether we are getting 40 or not. So let us try this compounding effect for 16%. So now let us see whether we are getting 40 at 1 plus 0.16 raised to the power 25 or not. Okay. So because now if we are increasing the rate, then definitely this future value interest factor for 25 years will definitely be more, and we want this to be 40. So let us just try this at 1.16 raised to the power 25. So now this will give you 1.16 square 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25. So this gives you 40.87. So now guys, this is the future value interest factor. So again, you know, exactly 16% is not the rate at which you are getting 40. So now your 40 lies between 15 and 16%. So what we need to do is, we need to use trial and error method. Your future value interest factor is coming as 32.92, whereas at 16% this is coming as 40.87. So somewhere between 15 to 16 lies your return for an investor or the cost for the particular company. So now we will take the difference. So as you can see, the difference between 15 to 16, you know, we call this interpolation while doing your capital budgeting. So here also the same concept will be applicable. Between 15 to 16 the rate is 1%, and the difference is nothing but 40.87 minus 32.92. So the difference comes as your 7.95. But my dear students, we just want to go from your 40 to 32.92. So 40 minus your 32.92 will give you 7.08, and for this how much percentage should we increase your rate? So guys, while doing this particular interpolation, 7.08 into 1, and you will, when you will divide this by 7.95, you will be getting this as 0.89%. So hence 15% plus your 0.89% will give you 15.89%, and guys, this will be the rate at which your zero coupon bonds is going to give you return, or this will be called as your cost of debt for the particular company. So guys, in this particular question, you have to remember that whenever there is a zero coupon bond, interest will be definitely zero, so that will not be considered as the cost for the particular company. So what is the cost for the company? Whatever is the capital appreciation which is being earned by the investor, that becomes your cost. So there will be only one outflow for a particular company at the end, which will be nothing but 1 lakh rupees, and the particular company is going to get 25,000 right now at the beginning. So that is why your present value is 2,500, your future value is 1 lakh. And then guys, we are just going to apply trial and error method. We checked it at 15%, so this was coming as 32.92. We checked it at 16%, it's coming as 40.87. So somewhere between the two, you will be getting your IRR, which is nothing but your 15.89%. So this will give you the final answer. Okay. So with this, my dear students, your first question gets completed. I hope you all have understood how to calculate cost of debt for your zero coupon bond. So now students, let's continue further with your question number 2. And this is regarding your amortization of the bond. See what is given to you. RBML is proposing to sell a 5-year bond of rupees 5,000 at 8% rate of interest, and the bond amount will be amortized equally over its life. So guys, if such kind of bonds are being issued by the particular company, the redemption amount is not just paid once, but it will be paid over the period of 5 years in equal amounts. You are required to calculate bond's present value for an investor if he expects a minimum rate of return of 6%. So basically here we are required to calculate the value of the bond. Now see, how do you determine the value of the bond? We will just calculate whatever is going to be the future value of cash inflows which we are going to receive from the bond, and those future value of cash inflows we will discount it at the investor's rate of return, which is nothing but 6%. We will be getting the present value of the bond. See, in capital budgeting also, my dear students, you have understood this concept that whenever we want to invest in a particular project, we estimate that what is going to be the future cash inflows we are going to receive from the particular project over some number of years, and those future value of cash inflows we will discount it at the investor's required rate of return, and we will be getting the present value of the same. Same concept applies here as well, my dear students, that we have to estimate that what is going to be the future value of the cash inflows we are going to receive from the bonds, and those future value of cash inflows we will discount it and we will bring it to the present value terms. That will be considered as the value of the bond. Okay. So guys, here first let us write down in your question number 2 that what is going to be your face value of the bond. Your face value of the bond is rupees 5,000. What is your rate of interest? Your rate of interest is nothing but 8%. So your interest is 8% on per annum basis. And guys, you are going to amortize this particular bond over the life of 5 years. Okay. So what is the discounting factor? What is the minimum required rate of return of an investor? So that's nothing but 6%. So guys, we have to first estimate that what is going to be the future value of cash inflows we are going to receive from this bond if the investment is made today. And here in this particular question, the life of the bond is 5 years, and an investor will receive not only the redemption value every year, but the investor will also receive some interest. So redemption value plus interest will actually give you your total cash inflows, and these total cash inflows we will discount it at 6%. So we will be getting the present value of the bond. Okay. So guys, your redemption value will be what? Your face value is 5,000 rupees. If you divide it by 5 years, so your redemption value will be every year 1,000 rupees. The company is going to give it to you. Okay. And guys, think like this from the investor's perspective, that every year from the company, if you have invested in the bond today, at the end of year 1, you will be receiving 1,000. At the end of year 2, you will be receiving 1,000. At the end of year 3, you will be receiving 1,000, and so on. So your redemption is not happening only once, that is at the end of the project. Is it happening throughout the year? Yes or no? Yes sir, over the period of 5 years. And guys, your interest amount, how will you calculate your interest? So guys, to calculate your interest, just check At the end of year 1, it will be 5,000 multiplied by 8%. So at the end of year 1, 400 rupees will be the interest that will be received by an investor. In the second year, you can just check that 5,000 rupees was the face value of the bond and 1,000 is already being returned by the company to the investor. So for the second year, the interest will be on 4,000 rupees. So 4,000 you multiply that by 8%, you will be getting 320. Now again 1,000 rupees is returned back by the company to the investor. So now the outstanding amount is 3,000 rupees, and on 3,000 at 8%, this will give you 240. For fourth year, now 2,000 rupees is outstanding, and on that 2,000 at 8%, 160 will be considered here. And in the last case, on 1,000 at the rate of 8%, 80 will be the interest which will be provided. So interest, as you all know, will only be provided on the outstanding amount. First year, entire 5,000 rupees is outstanding. So that's why the company will pay the interest on entire 5,000 at the rate of 8%. For second year, 1,000 rupees is already been paid. It has been amortized. So 4,000 is the outstanding on which the interest will be taken into consideration. So now what will be your series of cash inflows? It will be 1,400, 1,320, 1,240, 1,160 and 1,080. And guys, the investors are expecting a return of 6%. So 1 divided by 1.06. So this will give you 0.9434. This will give you 0.8899. This will give you 0.8396. This will give you 0.7921. And the last one here will be 0.7473. So guys, after multiplying the cash flows with your discounting factors, you will be getting the present value, and the present value of the bond here will be coming as rupees 5,262.62. So this will be the present value of the bond, my dear students. So ultimately, this is the value of the bond as per the investor. Now, if suppose the company is issuing this particular bond at, let's say for example, at par, then what should we do? We just have to check whether investment should be made or not. So according to you, the value of the bond is 5,262. So your present value of cash inflows which you are going to come from the bond is 5,262. Now apply your NPV concepts which you have learned in your capital budgeting. So just check like this. Your present value of cash inflows, will be 5,262.62, and suppose your present value of cash outflows is, let's say, 5,000, then can I say that your net present value will be in positive, which is 262.62. Will you make investment? Come on, yes or no? Yes, sir. And if suppose your present value of the bond is less than 5,000, your NPV will be negative, so you will not make the investment for the same. Okay. So guys, something like that you can take it into consideration for the purpose of calculating the decision making, that is whether the investment should be made or not. Here in this particular case, we have to think like this, that an investor whose required rate of return is 6% means that the discounting factor will be treated as 6%, and we are going to discount that from your future value to present value. Okay. So guys, this is what we are going to do in your question number 2. I hope you have understood the solution for this particular question. Okay students, now let us start with the next question. Mr. Mehra had purchased a share of Alpha Limited for rupees 1,000 and he received dividend for a period of 5 years at the rate of 10%, and at the end of the 5th year he sold the share of Alpha for rupees 1,128, and you are required to compute the cost of equity as per realized yield approach. So guys, now what is this realized yield approach? This is very similar to the concept of IRR. What used to happen in IRR, we used to find out a rate at which your present value of cash inflow is equal to present value of cash outflows. So here also we have to find out a rate at which your PV of C and PV of CO will be the same using your trial and error method. So basically what happens in a realized yield approach is, you have to think like this from the investor's perspective, that if you are going to purchase the equity shares, then your PV of CO will be the market price of the equity share, which is nothing but in this particular question 1,000 rupees, and then we need to check that what is the time period of holding. So this particular investor is holding the equity share for the period of 5 years. So there will be a series of cash inflows which is going to receive for the period of 5 years by the way of dividends, and at the end of the 5th year he will be selling the equity share. So the market price at the end of the 5th year should also be available to you, which is also given in this particular question. So now we have the series of future value of cash inflows, we have the PV of CO. So what will be the rate at which your PV of CI will be equal to PV of CO, and that is something which we have to calculate in this particular question. So we are going to use trial and error method and then interpolation to calculate your realized yield or your IRR, or in this particular question you can also call this as your KE. So that's why the revision of this particular question should only be done, if your capital budgeting chapter is done once. Okay, so after that particular chapter is done, then you will understand the concept of IRR very quickly, and you will be able to discount from everything from future value to present value, and that's how the calculation will be done. So this IRR you can calculate the way you have done it in the class, so that's absolutely fine. But the concept is what, that realized yield approach is similar to your IRR. So how much is the equity shareholder going to earn if the PV of CO is 1000, and the rate at which your PV of CI will be equal to PV of CO, that will be called as your realized yield. And guys, whatever is the yield for equity shareholders, can I say that's nothing but the cost of equity for the company? Come on, yes or no? Yes sir. Okay, so now how will we approach this particular question? So you can just see here that in this particular case the share is purchased for ₹1000, okay, and you have dividends available at the rate of 10%, so that will be ₹100 every year, and at the end of the 5th year the market price is nothing but ₹1128. Now sometimes they will give you the market price at the end of the 5th year, or else they will give you the data on the basis of which you can calculate the market price also at the end of the 5th year, or at the end of the particular time frame after which an investor wants to sell the share. Here in this particular question you have the market price readily available. So guys, let's calculate the KE. Okay, so how will you approach? You all can solve this along with me. Question number 3, you can write down here, realized yield is similar to internal rate of return. At IRR, PV of CI is equal to PV of CO, and your PV of CO is 1000, hence your PV of CI will also become 1000. So now we have the cash inflows available for the period of 5 years by the way of dividend per share, and also by the way of your market price at the end of the 5th year. So these will be your future value of cash inflows. We have to discount it in such a way that your PV of CI here should come as ₹1000. So we will be using definitely the concept of trial and error method. So guys, your dividend per share will be 100, and the market price at the end of the 5th year will become 1128. So this will be 1228. Okay, and guys, now using your trial and error method, we can start this particular discounting at the rate of, let's say, 10%, and just check whether we are getting present value of cash inflow as 1000 or not. So if we get the present value of cash inflow here as 1000, then can I say that 10% is nothing but the realized yield? Come on, yes or no? Yes sir. So 1 divided by 1.1, you can multiply this by 100, 1 divided by 1.1, 2 years discounting factor, you can multiply this by 100, 1 divided by 1.1, 3 times discounting factor, you can multiply it by 100, 1 divided by 1.1, 4 times discounting factor, you can multiply that by 100, and 1 divided by 1.1, 5 times, you can multiply that by 1228, and the total of this will be ₹1079.48. Now my dear students, 1079.48, is it greater than 1000? Come on, yes or no? Yes sir. Now we know that we have to increase the discounting factor so that the present value of cash inflows will come down to ₹1000. So now you can take the discounting factor as, let's say for example 15%, and let us see whether your present value of cash inflow here will be coming as 1000 or not. Okay. Now this, my dear students, you can do it the way you have understood IRR in your classes, in your particular lectures. So that is what the base can be taken here, but the concept is what, that using trial and error method, using your interpolation technique, you have to calculate the discounting factor, you have to calculate that rate at which your PV of CI is equal to PV of CO. So 1 divided by 1.15, you need to multiply this by 100. 1 divided by 1.15, 2 times discounting factor, you have to multiply that by 100. 3 times discounting factor, you need to multiply that by 100. 4 times discounting factor, you need to multiply it by 100. 5 times you have to multiply that by 1228. The total of this will be rupees 896.03. So as you can see, my dear students, that this particular cash inflow is lower than 1000, and we have the first cash inflows which is higher than 1000. So guys, now your IRR lies somewhere between 10% and 15%. So that is why, using your interpolation, your IRR will be 10% plus something. So we know that the difference between 10 and 15 is nothing but 5, and if we are increasing the discounting factor by 5%, we are actually reducing the present value of cash inflow from 1079.48 to 896.03. So this will be nothing but 183.45. But guys, we just have to reach from 1079.48 to 1000. So we need to now discount 79.48. So 79.48, for that it will be 2.17. So basically now, if I consider here, this will be nothing but 12.17%. So guys, this is the rate at which your PV of CI will be equal to PV of CO, and this will be your realized yield. So think from the equity shareholder's perspective, that an equity shareholder is investing right now 1000 rupees, and whatever future value of cash inflows the equity shareholder is going to get, if we discount it and if we bring it to present value terms, then it will be nothing but at the rate of 12.17%. So that will be your realized yield from the perspective of equity shareholders. Okay, and whatever is your realized yield from the perspective of equity shareholders, that's nothing but the KE for the particular company. So finally your KE will be how much? It's nothing but 12.17%. Okay, so guys, with this your question number 3 gets completed, which you will find it in the study module also as your illustration 10. Okay, and there they have considered it directly, a random percentage of 12% without using any trial and error technique there, and that's how they have done it. But here basically the concept is what, that how will you come to know that at what percentage your PV of CI is equal to PV of CO. So you can use this technique to understand the same. Okay, so that's it regarding your question number 3. Okay students, now let us start with the next question. You are required to calculate the cost of equity from the following data using again your realized yield approach. And guys, here they have just given you simply year 1 to year 5 dividend per share, and guys they have told you price at the beginning is available. Now this question, my dear students, you have to just apply your basic concepts, that first of all your realized yield approach is nothing but the rate at which your present value of cash inflow is equal to present value of cash outflows, right? Similar to your IRR technique. Now in this particular question, first of all, they have not told you the price at which an investor is going to invest. But don't you think, applying common sense, an investment will always be done at your year 0. So your present value of cash outflow will be nothing but the price at year 0. So guys, you can just check, they have told you price per share at the beginning. So at the beginning it means what? At the beginning of year 1. Guys, at the beginning of year 1 means, can I say this is nothing but the price of an equity share at year 0? Because when we are talking about beginning of the year, it's nothing but year 0 only. So that is why at year 1 beginning, we are investing in a particular equity share at rupees 9. So that will be nothing but your present value of cash outflow from the investor's perspective. So when an investor is going to buy this particular equity share, investor knows that from his pocket rupees 9 will go. So that's nothing but your PV of CO. Okay. And then we have dividend per share for year 1 to year 5. Now understand like this, dividend per share, my dear students, is nothing but your cash inflows, and you will only receive this at the end of the year. So that's why in dividend per share nothing is given in the bracket, because it is implied that this dividend will always be received at the end of the year. So guys, just like the previous question, you were receiving dividends at the end of the year, and then your PV of CO was also available directly. Here we just have to identify what will be your present value of cash outflows. It will be nothing but 9 rupees. So that will be your price at the beginning of year 1, which is nothing but year 0. So an investor is going to spend 9 rupees right now, and we have to just identify what will be the series of holdings, what will be the series of cash inflows over the period of your tenure, and then we will discount it in such a way that your PV of CI should be equal to PV of CO. So in that particular case, my dear students, in this question, they have not specified that at what price an investor is going to sell his particular equity share. But now, don't you think it's obvious that we have the price at the beginning of the 5th year available? Now, price at the beginning of the 5th year also implies the market price at the end of the 4th year. So guys, just 1 second, pay attention. If I am going to consider here, let's say for example, my time period from year 1, 2, 3, 4 and 5. Example, if I consider my investment time period from year 1 to year 5, then don't you think that I need the market price at the end of the 5th year to consider its cash inflows? Come on, yes or no? Yes, sir. But in this particular case, we don't have the market price at the end of the 5th year. We have the market price at the beginning of the 5th year. And guys, market price at the beginning of the 5th year means that we have the market price at the end of the 4th year. So here, to calculate your realized yield, we cannot take time period as 5 years. Unlike the previous question, where we took that an equity shareholder was investing over the period of 5 years and he was selling an equity share at the end of the 5th year. But that is not possible here, because we have the market price at the beginning of the 5th year, which means that we have the market price at the end of the 4th year. So here, my dear students, what are we going to do is, we will be considering year 1 to year 4, and we will develop the cash inflows for the period of 4 years, and then we will find out the rate at which your PV of CI should be equal to PV of CO. Okay. So guys, you all can solve this along with me. In this solution to question number 4, you can write down year 1 to year 4, you will be having your dividend per share, then we will be writing down the market price per share, we will be getting the cash inflows, we have to discount it at a particular rate in such a way that your PV of CI should be equal to PV of CO. Okay. So considering guys, all this is your revision, you have to be very fast in your calculations as well. Okay. So we'll just write down here at the beginning, at IRR, PV of CI is equal to your PV of CO. Okay. And what is your PV of CO? So guys, your present value of cash outflow, if you want to invest in this particular equity share, then you have to invest today, and today the market price is nothing but 9 rupees. Okay. So guys, your PV of CO will be rupees 9. Okay. So we have to discount it in such a way that your PV of CI will also become 9 rupees, and we have the dividend per share as 1. Then at the end of the 2nd year also we have 1. At the end of 3rd year it is 1.2, and at the end of 4th year it is 1.25. And guys, what is the market price at the end of the 4th year? It's nothing but 10.6. So guys, these are going to be your series of cash inflows. Okay. So only for your reference, you can just write down like this: dividends are received at the end of year. And in the next line you can write down price of equity share at beginning of 5th year is equal to price of equity share at end of 4th year. Price of equity share at the beginning of 5th year is equal to price of equity share at the end of the 4th year. Okay. So now my dear students, will be having the cash inflows as 1.2 and then there is 11.85. Now what will be the discounting factor? So using trial and error method, let us start it at 10% and let us see what is your PV of CI. So guys, this will be coming as your rupees 10.73. So very soon you must have realized that 10% is not your realized yield, because at 10% your PV of CI and PV of CI is not the same. So 10% is not your realized yield. So now let us try at some another percentage. So let us try this at discounting factor 15% and let's see what's your PV of CI, because now you have to increase your discounting factor in such a way that your PV of CI should be 9. Okay. So let's get started now at 15%. So guys, this will be coming as 9.19. So now we are very close to your present value of cash inflow of rupees 9, but still we have not reached the target, but we are very close to your 9 rupees, which should be your PV of CI equal to PV of CO. So now let us try this particular discounting factor at the rate of 16% and let us see what is going to be your PV of CI. So then we can use the concept of interpolation. Okay. So we just have to now discount up to an extent in such a way that it becomes equal to your 0.19. So let's get started now at 16%. So guys, this will be coming as now rupees 8.91. So now we have a range available, and using the concept of interpolation, will we be able to calculate your realized yield? Yes or no? Yes sir. So now here you can just check 15% and 16%. So this is greater than your PV of CI, desired PV of CI, which is rupees 9, and this is lower than your desired PV of CI, which is nothing but 8.91. Now what we need to do is we will be using interpolation to calculate the same. So using your interpolation, we'll be taking 15% plus something. So the difference between 15 and 16 is 1, and in this difference we are discounting from 9.19 to 8.91. So that's nothing but 0.28, and you all can just check that we have to discount up to the extent of 0.19. So this should be how much? So this will be 0.68%. So approximately, my dear students, your realized yield is nothing but 15.68%. Okay. So guys, slightly, the answers will vary depending upon the technique which you are using here, but your approximately answer will be somewhere between 15.68%. So with this, my dear students, now your realized yield approach gets completed, but I hope you all have understood this concept first, that in this particular question we were not having any particular data available regarding when are we purchasing the equity share, when are we selling the particular equity share. But guys, it's very obvious that we are investing today. So when we are investing in the equity share today, we should have the market price at year 0, and the moment we have that, then you have to think like this, that what will be the series of cash inflows which you are going to receive over the particular tenure of investment. Now the moment you check the question, you will realize that sir, here the time period is 5 years. So the time period is 5 years, so let us consider the time horizon for the purpose of investment as 5 years. But in that situation, you will need the market price at the end of the 5th year. But here we have the prices at the beginning. And guys, the price at the beginning of the 5th year can also be related to the price at the end of the 4th year. So your tenure of investments will now be for the period of 4 years. And using the concept of IRR, we have to calculate the rate at which your PV of CI becomes equals to your PV of CO. Okay. So that's how, my dear students, you will be completing your question number 4. Okay students, now let us start with the next question. Now what is given to you in question number 5? Cost of equity of a company is nothing but 10.41% and the cost of retained earnings is 10%. There are 50,000 equity share of rupees 10 each and retained earnings is nothing but 15 lakhs. Market price per equity share is 50 rupees and you are required to calculate the WACC using market value weights if there are no other sources of finance. So my dear students, in this particular question you are required to calculate your WACC using your market value weights. So first of all my dear students, you have to understand like this, that your KE and KR usually are the same, and that's why in market value weights we always ignore your reserves and surplus, because the market price of an equity share is always after considering the impact of your reserves and surplus, right? So basically whenever your KE is equal to your KR, whenever your KE is equal to your KR, okay, understand like this, in such a situation, we ignore reserves and surplus in market value weights, okay. But my dear students, here KE is not equal to KR and therefore we will have to consider reserves and surplus in market value weights. So in this situation what you need to do is, we'll be dividing the market value of equity, share capital, okay, into equity share capital and your reserves and surplus, and this will be doing it with the help of your book value weights, okay. So guys, what is the approach? See, it's very simple. In usual situations your KE is equal to your KR, so in book value weights definitely we consider your reserves and surplus, but in market value weights we tend to ignore it because market value of equity is after considering the impact of your reserves and surplus. So that is why your KE is equal to KR. So even if you bifurcate the market value of equity into equity share capital and your reserves and surplus, in that situation also your answer will be the same only, because your KE and KR both are same. But guys, when KE is not equal to KR, then it is required to consider your reserves and surplus in your market value weights. So whatever is the market value of equity, we have to divide that into equity share capital and reserves and surplus using your book value weights, and then we'll be having market value of equity, we'll be having market value of reserves and surplus, and then we are having your KE, KR as two separate components, and then on the basis of which we'll be calculating your overall cost, okay. So here in this particular question you can just check, your KE is 10.41 and your KR is nothing but 10%. So whatever is the market value of equity share capital, we need to bifurcate that. So we are required to calculate WACC using market value weights. So how will you approach this? So a solution to question number 5 will be like this: calculation of WACC using market value weights. So here we'll be considering sources of funds, amount, we'll be considering weights, we'll be considering cost of capital, and from weights if we'll multiply the cost of capital, we'll be getting the weighted average cost of capital. So here we'll be considering your equity share capital as well as your reserves and surplus. And guys, what will be the amount of the same? So we have to first find out the market value of equity and divide that in the book value proportions. So guys, we have here number of equity shares as 50,000 and the market price is 50, okay. So it's nothing but 50,000 shares into 50, and that's nothing but 25 lakhs. So we are having the total market value of equity as your 25 lakhs. Now let's divide this, in your equity share capital and your reserves and surplus by considering book value weights. And in this particular question you can just check that you have 50,000 equity share of rupees 10 each. So basically your book value, we have equity share capital as 5 lakhs and your reserves and surplus is nothing but rupees 15 lakhs. So basically this is total 20 lakhs. And guys, now we have equity share capital proportion as 5 divided by 20. So that's nothing but 0.25, and obviously this will become 15 divided by 20, which is 0.75. So guys, you can just bifurcate now this 25 lakh rupees into two components, 0.25 and 0.75. 0.25 being your equity share capital. So 25 lakhs into your 0.25. So this will now give you 6 lakh 25,000, and this will be nothing but 18 lakh 75,000. So guys, we have this as 6 lakh 25. We have this as 18 lakh 75,000. So now the weights will be 0.25 and this will be your 0.75. Okay. And guys, we have the KE available. What is your KE? You can check your KE is nothing but your 10.41%. And guys, your KR is nothing but 10%. So now you are in the position to calculate your WACC. So this will be 10.10%. So guys, 10.10%, that's your overall cost using your market value weights. And you can also check this. This is your study module question, illustration 16. And the only thing which you have to recollect here is that whenever your KE and KR both will be different, we have to consider market value weights, and we will consider reserves and surplus also as a part of it. We'll just simply divide the market value of equity in your book value proportions. Okay. So with this, my dear students, now your question number 5 also gets completed. Okay students, now let us start with the next question. What is given to your company issued 10,000 10% debenture of rupees 100 each on 1st of April 2013 to be matured on 1st of April 2018, and the company wants to know the current cost of its existing debt and the market price of the debenture is given to you as rupees 80. Compute the cost of existing debentures assuming 35% tax rate. Now see, in this institute's example number 2 on page number 4.1, they have solved this on the basis of their yield to maturity. So let me quickly revise. What is your YTM? What is your yield to maturity? Guys, yield to maturity is similar to your internal rate of return. At your yield to maturity, your present value of cash inflow should be equal to your present value of cash outflow. So we just have to identify what will be the series of your cash flows, and then we have to discount it in such a way that your PV of CI is equal to PV of CO. Okay. So think like this, that if suppose an investor is going to invest in this particular debentures, then he is going to invest today at the market price which is given to you as rupees 80, and then over the period of tenure, interest will be received. Of course, we have to convert interest from pre-tax to post-tax, because as you all are aware that interest being debited in the P&L account will be subject to your tax savings. So similarly here also we have to convert that particular interest from pre-tax to post-tax, and then guys, at the time of redemption, what will be the amount which the company is going to give. So guys, if no information is given to you, then we'll assume that the redemption is to be done at par. And guys, what will be the series of cash inflows? We are going to discount it in such a way that your PV of CI becomes equals to your PV of CO, and that also, my dear students, using your trial and error method. So now if you think from the company's perspective, your present value will be 80 rupees. So we have to discount all the series of cash flows in such a way that it becomes equal to 80. Okay. And this we are going to use trial and error method for the same, use the concepts of your IRR and do it accordingly. Okay. So guys, first of all, let us write down the facts of this particular question, which all things are available to you. Now, in this particular question, your face value is nothing but rupees 100. Then you have your tenure as 5 years, because we are issuing the debentures on 1st April 2013. So 14, 15, 16, 17 and 18, 5 years. Your redemption value will be at par only. So that will be nothing but rupees 100. And guys, we have the current market price, which is nothing but rupees 80. So we can actually also state this as your net proceeds, because when the company is going to issue these particular debentures, then the company will receive 80 rupees. And guys, your interest rate is nothing but 10%, and your tax rate is also given to you, which is nothing but 35%. So guys, we know that the present value right now is nothing but 80 rupees. So we have to discount all the future value of cash inflows into present value in such a way that it becomes nothing but 80. So we have to do this using your trial and error method. So using concept of yield to maturity, in bracket you can write down similar to IRR, convert all future value of cash flows into present value using trial and error method. So now, as you all are aware that the tenure is 5 years, so here we will be writing down the tenure, year 1, 2, 3, 4 and 5. Guys, interest, always remember that while calculating your cost of debt, you always know that your interest is subject to your tax savings. So that is why we have the interest available as 10 rupees, which is nothing but 10% of your 100, but it is subject to 35% tax rate. So that's why we'll write down interest into 1 minus tax. So guys, 10 into 0.65, this will now become 6.5. So guys, this 6.5 will be your interest over the period of 5 years, to which we have to add the redemption value, which is nothing but 100 rupees. So this will now become 106.5. And now guys, we just have to discount it at a particular percent in such a way that we should get the present value here as rupees 80, okay, because that's nothing but the current market price. So using trial and error method, you can use any particular discounting factor. Let's say for example, I'm using 10%. So 1 divided by 1.1, 1, 2, 3, 4, okay, and this I will multiply it by 6.5. So this will now give me my present value of 20.60 plus 1 divided by 1.1, 2, 3, 4, 5. This I will multiply it by 106.5. So this will now give me 66.13. And guys, the total of this will now become 86.73. And guys, as you can just check that at 10%, your PV of CI and PV of CO is not coming the same. Your future value of cash flows are not getting discounted at the current market price of rupees 80. So now we have to bring this 86.73 to your 80. And how will you do that? Can I say you will enhance the discounting factor? So let us try this at 15% and let us check at 15% is the present value coming total as 80 or not. Okay. So now 1 divided by 1.15. So guys, now this will be 52.95 plus 18.58, which will now give you 71.53. So now very well you can just check that your IRR lies between 10% and your 15%. So guys, we will start with 10%, and using your interpolation technique or any particular method which you have done it in your class, it's absolutely fine because the concept is going to remain the same only about calculation of IRR. But you can do this by considering between 10 and 15 the range is 5%, and in your 5% you are discounting from 86.73 minus 71.53. So 86.73 minus 71.53, so that will be 15.2. So now from 86.73 you have to reach 80. So for 6.73 it should be how much? So 6.73 into 5, divide that by 15.2. So this will be 2.21%. So approximately this is 12.21%. So at 12.21%, my dear students, your PV of CI and your PV of CO will be same, or else you can also put it in this words that whatever is going to be your future value of cash flows, that will be equal to your current market price, that is nothing but 80 rupees at this 12.21%. So guys, we are going to use trial and error method to calculate your YTM. Now, if you also cross check, you know the normal formula of KD, which is nothing but interest into 1 minus tax plus RV minus NP upon N, the whole upon RV plus NP upon 2, right? Now, in this particular case, if you can recollect, we used to always take interest, which was 10, into 1 minus 0.35. Your redemption value was 100. Your net proceeds is 80. You divide that by the life of 5 years and you divide that by 100 plus 80 upon 2. So now 10 into 0.65, this will be 6.5 plus 100 minus 80 divided by 5, that's nothing but 4, and you have to divide this by the average. So you will come to know the answer for this is 6.5 plus 4, divide that by 90 into 100. Approximately you will be getting some 11.67%. So guys, here it is coming as 12.21%, here it is coming as 11.67% approximately. See, sometimes you want to determine the range, that at which particular range your PV of C and your PV of CO will be the same. Then in that particular case now, using this concept of formula, first you can determine that 11.67%, approximately, you can take the range of 10 and 15, because sometimes you are helpless that you don't know that how should we start with, right? At which particular discounting factor, should we start with 5%, should we start with 10%, 15%, 20%? So by applying this formula, you come to know that it will be around 11.67%. So you can take a range of 10 and 13, 10 and 15 to calculate your IRR as well. Okay. So guys, now this rounding of errors will always prevail because of how much discounting you are taking into consideration. So approximate answer should be this much part, and which is also similar to this particular example which is given to you in your study module. Okay. So this YTM concept should only be used to calculate your KD if they have specifically asked in the question. So just to revise, whenever they ask you to calculate your yield to maturity, make sure that you first identify what is the current market price of the particular instrument, estimate the future value of cash flows, and then discount it using trial and error method in such a way that it becomes equal to your current market price. Okay. So that will be your cost of debt for the particular company. So with this, my dear students, now we complete your question number 6. Now let us start with your question number 7. Now in this particular question, see, you are required to calculate WACC using book value weights and market value weights, and we have the debentures available, we have preferences available, we have equity shares. And guys, the market price of debenture is 105, preference share is 110, and that of equity share is 24. And then you have this additional information available, and they have told you that the next year expected dividend is 1 with growth of 5%. And guys, in this particular question, you are required to use YTM method to calculate the cost of debentures and preference shares. Now, whenever such kind of YTM is explicitly given to you in the question, make sure that you use trial and error method to calculate your KD and KP. Now, this similar question we have also done it in our classwork section, where the usage of YTM was not been done. We just calculated your KD and KP using the normal formula only. Guys, in this particular question, we are going to use the same concept, but here we are going to consider your YTM only to calculate your KD and KP. Now see, this question will not be solving this entirely. I will be just solving the YTM part of it. See, in this question number 7, what is going to happen is, we are required to calculate WACC using book value weights and market value weights. So the approach of the question, you know that for book value weights, we are going to prepare one table where there will be sources of funds, there will be amount, there will be weights, then there will be cost of capital, and then there will be WACC, right? And for market value weights, we are going to prepare the table like this only: sources, amount, weights, and then there will be your cost of capital and WACC, right? So guys, if this is book value weights, your amount column of equity share capital, preference share capital, and debentures. You will write down from the balance sheet which is existing given to you. And for market value weights, you all are aware that your equity share capital, preference share capital and debentures, in the amount column you will be writing down the market values. Okay. So in your market value weights, we will be writing down the market values and then the weights will be accordingly calculated. Now guys, this COC, your cost of capital, will remain the same whether it is book value or market value. And this cost of capital, how will you calculate? So you can also calculate KE using dividend yield growth approach, because that is given to you in the question. We have the growth rate of 5%, expected dividend is 1 and your net proceeds will be 20 rupees, and that's how your KE will be calculated. For your KP and KD, you all know the formula, that KD is equal to interest into 1 minus tax plus RV minus NP, the whole upon RV plus NP upon 2 etc. into 100. So that is the formula for KD and KP. But guys, here in this particular question, they have told you that you are going to use YTM method, okay, yield to maturity. So your KD and KP will be calculated in a different way. So that is something which we are going to revise in this particular question. See, as we have just now discussed in the previous question, that if you are calculating your KD using your yield to maturity, then in that particular case, we have to first estimate what is going to be the future value of cash flows, and we have to discount it in such a way that it equates to your market price of the debenture as on today. So first of all, do we have the market price of the debenture available? Come on, yes or no? Yes sir. The market price of the debenture, they have told you it's nothing but 105. So market price is 105, and now from this you have to subtract flotation cost. Now this flotation cost is given to you as 4%. Now in the revised study module, while calculating your YTM, they have considered 4% of the market price. So from 105 minus 4%, the net proceeds will be rupees 100.8. Of course, alternatively, you can also assume that on the face value and then calculate your net proceeds. But this is what ICI has done. Right now, from the market price, they have subtracted flotation cost of 4%. Your net proceeds is 100.8. So we have to discount it in such a way that it becomes equal to your 100.8. So your year 1 to 10, are we receiving some cash flows by the way of your interest? Come on, yes or no? Yes, because the tenure year is 10 years and the redemption is done at par. So basically we are going to have interest from year 1 to year 10. Now instead of doing year 1, 2, 3, 4, 5, 6 and then using the present value for each and every year, we can use annuity factor concept to calculate your present value. So what we will do is year 1 to year 10, you know that your interest is 10 rupees, okay. As you can just check here, the interest is 10 rupees and the tax rate is given to you as your 30%. So 10 into 1 minus 0.3, so your post tax interest will be 7, okay. And at the end of the 10th year, you will be redeeming this particular debenture at par. So that will be nothing but 100 only, okay. So this 7 per annum, we will multiply it by PVAF to get its present value, and this 100 will multiply that by the present value factor at the end of 10th year, okay. So guys, let us take a discounting factor. So you can start with a discounting factor of, let's say for example, here let us start with 5% and just check whether whatever is going to be your present value of cash inflows, how much is it coming. So let's start at 5% and just check using trial and error method, any random figure. So here we are going to start at 5%. So this PVA figure will be 1 divided by 1.05. So this will be 7.7217, which will multiply by 7, which will give you 54.05, and this will be nothing but 0.6139. So if I multiply this by 100, this will now become 61.39, and if I add up both these things, 61.39 plus 54.05, so I'll be getting this as rupees 115.44. So I know that this is not going to be my discounting factor. Now I have to further enhance the discounting factor in such a way that it becomes equal to 100.8. So let me now try at 10% and check. So now this particular year 1 to 10, let us try at interest, which is 10 into 1 minus 0.3, that is 7 per annum. Let us multiply that by the PVAF at 10%. So 1 divided by 1.1. So first of all, your PV factor at the end of the 10th year will become 100 into, this factor will be 0.3855 and this will be 6.1446. So if I take 6.1446 and multiply that by 7, so that will give me like 43, and this 100, if I multiply that by the PV factor of 10% at the end of your 10th year, so this will now become 100 into 0.3855, so this will be 38.55. So the total of this will become 81.55, and guys, this 115.44 is going to be greater than your net proceeds, which is nothing but 100.8, and guys, this particular 81.55 is less than your rupees 100.8. So guys, have we identified, what is the range? So as you all can just check, at 5% your PV of CI is coming as rupees 115.44. At 10% this is coming as rupees 81.55. So this is greater than rupees 100.8. This is less than rupees 100.8. So 100.8 lies somewhere between 5 and 10. So using your interpolation technique, my dear students, again I am repeating that this can be done the way you know how to calculate your IRR by any particular method. So it's 5% plus something, and the difference between 5 and 10 is nothing but 5, and in this we are subtracting from 115.44 minus 81.55. So this will be 33.89, and now from 115.44 to 100, can I say 15.44? This should be how much? So if you cross multiply 15.44 into 5 divided by 33.89, so this will be 2.28%. So if I add 2.28% to it, this will be 7.28%. So guys, this is an approximate answer that your yield to maturity will be somewhere, between 5 to 10. Approximately this is coming as 7.28%. And guys, let me tell you one trick here, that if you lower the range, the better accurate your IRR will come. So we have taken a range of 5 to 10. If you take a range of, let's say, 5 to 8, and then if you keep on reducing the range, your IRR will be much more accurate. Okay. So now here, as per our calculations, we are seeing this as 7.28%. So this is coming as your IRR. Now similar to this, my dear students, let us now continue further for your calculation of your KP. So guys, for your calculation of cost of preferences, also the same series we have to take into consideration using your YTM. Here now the only difference is, my dear students, that we are going to take into consideration your preference dividend. Okay. First of all, what is the market price of the preference shares? Just check. The market price of the preference share is nothing but, in this particular question, 110. So market price is 110. From this I'll be subtracting the flotation cost at the rate of, just check, which is nothing but, flotation cost is 2%. So we'll subtract 2% from 110. So we'll be getting the net proceeds 110 minus 2%. That's nothing but rupees 107.8. Now my dear students, we have this as 107.8. We have to now take into consideration all the cash flows in such a way and discount it that it becomes equal to your 107.8. So your 1 to 10, this also has a life of 10 years. And guys, here there is 5% coupon rate, so your preference dividend will be 5. And guys, this 5 is not subject to any kind of tax savings, so we'll continue this with 5. And here we are going to take into consideration the discounting factor, again with the help of PVAF. And at the end of the 10th year, you also have the redemption, which will be nothing but 100 rupees. Okay. So now discounting will be done. Let's say, for example, you can try it at 5%. You will come to know that what is going to be your present value. Okay. So our basic objective is that it should be equal to 107.8. But now let's see at 5% what is the range which is coming. 1 divided by 1.05. So this will be 0.6139. Okay, and the total of this is 7.7217. If I multiply this by 5, this will become 38.61, and 100 into 0.6139, this will become 61.39. and if I add both these things, I'll be getting rupees 100. So guys, what has happened here, that at 5% we have discounted actually little more, because of which your PV is coming as less than 107.8. Now basically we have to reduce the discounting factor so that PV of CI shoots up. So at 5% we tried and this is not matching. Now let us try this at, let's say, 3%. So at 3%, let us check what is going to be your present value. So 1 divided by 1.03. So this is 0.7441 and this will be 8.5302. This 8.5302 I have to multiply it by 5. So 5 into 8.5302. So this is 42.65, and this 100 if I multiply it by 0.7441, so this will be 74.41. If I add 42.65 to it, then this will be 117.06. So I know that this is greater than 107.8. So now your IRR will be between 3 and 5. So it is more than 3% but less than 5. So the difference between 3 and 5 is 2, and at 2% difference, you can just check that we are discounting from 117.06 to 100. So that is nothing but 17.06, but we don't need to discount till 100. From 117.06 we just have to go to 107.8. so you just have to discount up to the extent of 9.26. so this should be how much? If you cross multiply this, you will be getting ultimately 1.08 or 1.09. So if I add 1.09% to it, this will become 4.09%. So your YTM is nothing but, my dear students, 4.09. This 4.09 is nothing but the rate at which your PV of CI will be equal to your PV of CO. Okay. So guys, now your KP is also calculated. So basically your KD and KP, we have learned how to calculate this using your concept of IRR, and you all can just check that your KD is 7.28% and your KP is coming as 4.09%. And guys, as I was telling you that the lower the range you take, the better accurate answer for IRR you will get. So sometimes your answer approximately will be different, but that's how the YTM method is all about. We are going to use trial and error method. So students can have any particular range and these rounding of errors can still persist in your solutions. So it depends upon what range you are taking, but always make sure that your one present value of cash inflow should be greater than the present value of cash outflow, and one PV of CI should be lower, than the desired present value of cash inflow. So basically you have to calculate your IRR accordingly. So with this, my dear students, now your question number 7, whatever value addition I wanted to tell you regarding the concept of YTM, we have taken that into consideration. Okay students, now let's continue further with the next question. Now this is your example 3, which is given to you in a study module. A company issued 10,000 15% convertible debenture of rupees 100 each with a maturity of 5 years. And guys, at maturity, the debenture holders will have the option to convert the debentures into equity shares of the company in the ratio of 1:10. So for each debenture, you are going to get 10 equity shares. The current market price of the equity share is 12 rupees, and historical the growth rate of the shares is 5% per annum. So you are required to compute the cost of the debenture assuming 35% tax rate. Now in this particular question, my dear students, we are going to consider the cost of convertible debentures. So at the end of the tenure, we are not going to give any redemption amount to our bondholders. Rather, conversion value plays a very important role here. So you all can just check that what is the ratio on the basis of which the equity shares will be issued. So here they have told you that for every debenture 10 shares will be issued and the current market price is given to you as 12 rupees. Now the conversion is not going to take place right now. The conversion will take place at the end of the 5th year. So that is why it is important that we should first estimate what should be the market price of the equity share at the end of the 5th year, because that will help you to calculate your conversion value. Okay. So now what we need to do here is, in this particular question, okay, we are required to calculate your cost of debentures only, and you can actually calculate your cost of debentures by using this formula as well. Interest into 1 minus tax plus, instead of redemption value we can write down conversion value minus whatever is going to be your net proceeds, and then we will divide it by the life of the particular debentures, and then whatever will be your conversion value plus whatever is your net proceeds, we'll take the average of the same. So guys, to calculate the interest, you can just check that the face value is 100 and the rate of interest is 15%. So you will be having your interest as 15. Your tax rate is available as, just check, they have told you it's 35%. And guys, the conversion value, here now this plays a very important role. The market price of equity share as on today is how much? 12 rupees. And guys, this 12 will grow at the rate of 5% for the period of 5 years. So the 5% growth rate is given to you for the period of 5 years. So this 12, let us add 5% for 5 years. 1, 2, 3, 4 and 5. So the price here after 5 years will now become rupees 15.32. We need to multiply it by 10 equity shares. So that will be 153.2. So you can consider your conversion value as 153.2. What is your net proceeds? Your net proceeds here, my dear students, is, they have told you that these particular debentures, okay, we are issuing it of rupees 100. There is no flotation cost which is given to you. So your net proceeds will be 100. And guys, your life will be 5 years. And we need to divide this by 153.2 plus 100 divided by 2. So you will be getting the answer as 16.09%. So guys, 16.09% will be your KD. And guys, alternatively, you can also use YTM method for the same. So in YTM, what will you do is, you will take a range of 15 to 17. So that will give you approximately the same percentage which you are getting here. So this alternatively can also be solved by the use of your YTM. But in examination also, guys, use YTM only if they have specifically mentioned. If they have not mentioned YTM, then we can use this particular formula to calculate your cost. Okay. So here the basic objective of revising this particular question was to make you understand that when the conversion value is given to you, so we have to take that into consideration and make sure that market price of one equity share is 15.32 and then there are 10 equity shares. So you need to multiply it by 10 equity shares, you will be getting 153.2. So that will be your conversion value, from which you are going to subtract the net proceeds of 100 and calculate it accordingly. Okay. So with this, my dear students, your question number 8 gets completed. So okay students, now let us start with the next question. ABC company's equity shares is quoted in the market of rupees 25 per share currently, and the company pays a dividend of rupees 2 per share, and the investors expect a growth rate of 6%. So you are required to calculate the company's cost of equity capital. Now that's very easy, because to calculate your KE, we have all the elements available by on the basis of which you can use your dividend yield growth approach, D1 upon P0 into 100 plus G. And now in this second part, if the company issues 10% debentures of the face value of rupees 100 each and it realizes rupees 96 per debenture, then while the debentures are redeemable after 12 years at a premium of 12%, you are required to calculate the cost of debentures using your yield to maturity, and the tax rate is 50%. So guys, in this particular question, now we are going to calculate the KD using YTM. Okay. So now till this particular time, I hope you all have realized at least one thing. At YTM, you have to discount all the future value of cash flows in such a way that it equates to your current market price of the debenture. And guys, the current market price of the debenture is 96 rupees. So guys, you can understand like this. I'll just be revising you with the YTM part because that dividend yield growth approach is extremely easy to calculate. Now in the second part, you have the current market price of the debenture, which is nothing but rupees 96. Just develop your series of cash flows. So you can just check that you are going to redeem this particular debentures after your 12 years. So from year 1 to year 12, you will be getting the interest, which will be nothing but 100 into 10%, that is 10, and this will be subject to tax savings where the tax rate is 50%. So this will be 5, and guys, at the end of the 12th year, we'll be redeeming this at a premium of 12%. So your face value is 100 and we'll be redeeming it at a premium of 12%. So this will now become 112. Okay. And guys, this will be your series of cash flows. We have to discount it. So when the interest on per annum is going to be constant, over the period of 12 years, we can definitely use annuity factor. And the same thing, we have to do for now whatever will be the redemption value at the end of the 12th year, that particular redemption value, you will be multiplying it by the discounting factor at the end of whatever is the PV factor at the end of the 12th year. So that will give you finally what is the present value. And guys, you have to equate it in such a way that it becomes 96 rupees. Now you can take any particular range here. So in this case, you try it first at 5% and then you try it at 10%. Ultimately, your IRR will be somewhere between 5 to 10. Using your trial and error method, you will be getting the answer. Okay. So guys, this is how you have to approach your question number 9. Again, here we are revising the concept of YTM. I have explained you the entire structure about how you will estimate the future value of cash flows. It should be equal to your current market price of 96. You have to take a range of 5 and 10, and then accordingly in examination it is very much possible that you will start at 10%, then you will realize no, we have to reduce the present value of cash flows, so we will enhance the discounting factor. Sometime we have to increase the present value of cash inflows, so for that we will reduce the discounting factor, and accordingly you have to make necessary adjustments. Use your interpolation to calculate your YTM. Okay, so the calculation part will remain the same. With this, your question number 9 gets completed. You can find this in your study module practical problem 3 to just verify your answer. So now let us start, students, with the next question. Now in this question also, which is your practical problem question number 5, we'll be discussing what are the differential points here. As in this particular question, you are required to calculate your WACC using book value weights and market value weights. And guys, you have your equity, share capital, reserves and surplus, preference shares and debentures. And we have book values available and we also have market value available. Now in your additional information, they have told you that your equity shares are quoted at rupees 130 and a new issue is priced at 125 and the flotation cost will be rupees 5 per share. Now in this particular case, my dear students, when you are calculating your KE, while calculating your KE, you are going to take into consideration the new issue price, which is 125 and the flotation cost is 5. So the market price is 130, we are issuing the shares at 125 and the flotation cost is rupees 5, which means that your net proceeds here should be 120. So while calculating your KE, make sure that you are considering 120, and while calculating your KR, here we should take into consideration 130 rupees, which is the market price per share. But in your ICR solution, you will see 125 rupees. But in the previous question, they have taken into consideration the market price only for the purpose of calculation of KR. So here also, my dear students, we have to continue with the market price only, and the market price will be 130 rupees. So for your KR calculation, you will divide it by 130, and for your KE calculation, you are going to take your net proceeds, which is nothing but your 120 rupees. Now after doing this particular thing, then your growth etc. will be calculated. Now how will you calculate your growth rate? Now that is also something which is new in this particular question, that the dividends are increasing from 10.6 to 14.19. Okay, so usually in our questions we used to always have the dividends year after year, that is at the end of first year, second year, third year, fourth year, etc. Here they have directly given to you that the dividends will grow from your 10.6 to 14.19. Now when such kind of situation will come, we have to calculate the growth rate as follows. As you all are aware, amount is equal to principal into 1 plus r raised to the power n. Now what will be the amount of the dividend at the end of the 5th year? It will be 14.19. What will be your principal? Your principal is nothing but 10.6 into 1 plus r raised to the power 5. So now in this particular case, if you take 14.19 and divide that by 10.6, ultimately you will be getting 1.3387 is equal to 1 plus r raised to the power 5. Now this 1.3387, my dear students, we are going to take into consideration from the perspective of calculation of your growth rate percentage. So for this you need to check your future value table which is given to you behind your study module, and there in that whatever is going to be the interest which you are going to earn at the end of the 5th year, the rates are given to you, and you will find that 1.3387 compounding rate is available at growth rate of 6%. So this you have to identify from the table. So you just have to check your future value interest factor table at the end of the 5th year, what will be your rate at which the compounding will give you 1.3387. So just by looking at the table, you will understand that the growth rate is coming as 6%. So once you have the growth rate available, then you can use your dividend yield growth approach for the purpose of calculation. Then my dear students, your preference share calculations are easy here, but yes, your debentures, in this particular case, you know what is given to you, that the debentures are proposed to be issued at 15%, but the yield on similar is nothing but 16% and flotation cost is 2%. And here guys, they have specifically mentioned that the flotation cost will be calculated on the face value. So the flotation cost will be 100 rupees is your face value of the debenture if no information is given to you, and on your 100 rupees your flotation cost will be 2%, so 2 rupees will be the flotation cost per rupee. But here first of all we have to understand that what will be your issue price of your debenture. So to calculate the issue price, my dear students, here they have specified that the company proposes to issue 15% debenture, but in the market the risk class is 16%. So guys, we cannot issue the debentures at 15% rate of interest when in the market our competitors have already issued debentures at the rate of 16%, because our competitors are offering higher interest as compared to us. So in that particular case, we have to compulsory issue it at a discount in such a way that the yield provided by this particular company is equal to the yield provided by the market. You are providing a yield of 15, but in the market the expectation is 16. So now what should be your issue price? So understand like this, that our competitors are providing a yield of 16 on the investment of 100. Now you are going to provide with an interest of 15. So what should be your issue price? So you just have to cross multiply this. So this will become 15 into 100 divided by 16, and this will give you eventually rupees 93.75. So guys, what is the meaning of this? That you have to compulsory issue your debentures at 93.75, so that even if you are providing the interest of 15%, it is equivalent to the yield which is provided by others or provided by the market at the rate of 16%. So always remember that if suppose in market people are expecting 16% and you want to issue the debentures which is providing with an interest of less than 16, then investors will only invest in your company if your issue price is below the face value. So if suppose you are issuing it at discount, so when you are issuing this at 93.75, will people invest in your particular company's debenture even if the rate of interest is 15%? Yes or no? Yes sir, because everywhere else they have to pay 100 rupees to earn 16%. Here they have to pay 93.75 to earn 15% of your interest, so your yield becomes equivalent. But from this 93.75, we need to subtract 2 rupees, which is nothing but your flotation cost, so your net proceeds will become 91.75. So guys, in this particular question I wanted to discuss these two important aspects, that is how do you calculate your growth rate. Your growth rate calculation was slightly different in this particular question, and secondly we understood that how do you calculate your debentures net proceeds. Okay, now in this particular question your KE and KR are not the same, your KE and KR are different. So that's why whatever is your market value of equity, please don't forget that to bifurcate on the basis of your book value weights. Okay, So that's it, my dear students, regarding some important value addition concepts which I wanted to discuss and revise in this particular chapter. I hope you have found it effective. Please go through it once. Wherever required, please solve the same as well. Okay. So that's it from my end. Wish you all the very best. Thank you so much. Bye bye. Take care.